Yeah, it's a great pleasure to have you all here. Thanks for coming. I hope we're looking forward for a really good conference. This year, the conference is co-hosted with the Bank of Italy. So it's a joint venture between the Collegio Carlo Alberto, the University of Turin, and the Bank of Italy. And yeah, I'm looking forward to a great conference, an aperitivo, and a dinner. So the day will be long, and I hope you have a good time in Turin. And pass the word to Michele.
Good morning, everyone. It's a pleasure to be here, and it's also a pleasure to have the chance to have an exchange of view and to discuss very interesting topics like decentralized finance. So I really hope that we have a fruitful discussion. So I don't want to waste another minute, and I think that it's better to start because we have a lot of paper to analyze and discuss. So have a nice day to everybody, and let's start.
Yeah, let's start. So the format is 25, 10, and 5. I think that you know. And yeah. Okay, so then as a host, I will open the conference with the first presentation. Yeah. And so the topic of this call is called Implied Impermanent Loss, a cross-section analysis of decentralized liquidity pools. And it's with Tom Lee from NYU, Siddharth Naik, who is also in the audience, and Andrew Papanikolaou from NCSU. And it's a follow-up paper to the other paper we wrote. And yeah, I mean, this slide we will probably see a few times today, but let's think about the situation where you want to trade Bitcoin for Ethereum on a decentralized exchange on the DEX. What is a DEX? A DEX is a trading platform, P2P, which is running on a blockchain. So it's a decentralized fashion. I think we know that. And the trading happens in a liquidity pool, and the liquidity pool is basically managed by an AMM, an automated market maker. And so there's no order book or central market maker here. The AMM sets the price according to some rule, typically, or often it's this construct product rule, for example. And due to this decentralization, basically anyone with funds, with Bitcoins or Ethereum, can become a liquidity provider, and he earns some trading fees. And this is called yield farming. So these LPs, they earn a share of the trading fees from these trades, but they are also exposed to several risks by doing so. And one of the major risks in all of these discussions is impermanent loss. And impermanent loss is basically if the fundamental value of one of the assets changes or both change, depending on the direction. If that happens, because of the dynamics in the liquidity pool, an arbitrageur enters the pool and he trades at the stale price and basically minimizes the value of the pool. So this is a type of adverse selection. And in this paper, so this is basically the overview. Again, the liquidity taker, he trades in the pool, he pays some fees. The fees are earned by the liquidity provider, which deposited the tokens, and the liquidity provider is also exposed to some risk, which is, okay, it doesn't work. So that's the yield farming kind of on a nutshell. And what we do in the paper is we connect the returns and the risks from on-chain liquidity provision to the derivative markets via information in the prices of the underlying tokens. So what we do is we provide a mathematical framework in continuous time to replicate the option applied impermanent loss. So this is important. It's an option applied measure. And we show that this measure can be decomposed into the tokens, like if you have a pair, into the individual token volatilities, but also their correlation. These two things, implied impermanent loss and implied correlation, we need to work it's not so easy to basically extract them. So we need to extract them using, for example, the Hansen-Jaeger-Nathan bounds, which I will talk about later. And then we use these measures to explain the cross-section of liquidity pools. So is there a relationship between APRs, future APRs from liquidity provision and risks, for example, the impermanent loss? What we show is that, and this is in line with the equity literature, that these option implied variables work better than their realized counterparts. So there's obviously some literature on these topics. And there's also a large literature on option implied information, but it's mostly for equities. There's a paper by Alexander Imager about the VRP for BTC besides that, and their VIX measure for the BTC for Bitcoin. Besides that, there is not really much about option implied information for cryptocurrencies. And yeah, and typically the literature is about, see another one. Sì. Ma il pointer non funziona purtroppo. Ok, grazie. Yeah. But what is the economic mechanism we are trying to establish, or which we think is the right one? So the LP is providing liquidity in a liquidity pool. Then there's innovation, for example, then there's innovation in one of the prices of the tokens, or in both. It can be either or. What happens if there's innovation, an arbitrageur enters the pool, the LP experiences impermanent loss, but also due to this trading since there's more trading in the pool, he earns more APR. So there is a link between innovation in tokens, like shock to fundamentals, impermanent loss, and APR. And the idea is basically that we obtain some expectation of the moments of this price innovation through option implied information. So let me quickly dive into the mathematical framework. So this is basically developed in the first paper, and the result is by now also known. So if you have an AMM and you assume some exogenous prices for the dynamics of the tokens outside the pool, you can then, due to arbitrage conditions, bring them into the pool, and you can calculate the impermanent loss as basically the integrated variance of the relative price. And then there's a 1/8, and it's negative. So the impermanent loss is basically the variance of the relative price. And this variance here is decomposed in the variance of token 1, the correlation between the two, and the variance of token 2. So already here, one sees, or one can infer, that the impermanent loss is a function of the tokens' variances and their correlation. Ok, questo non...
Sì, quello lì funziona.
Ok, scusa. Okay, so we have to stand here basically. And the question is, how can we value this option implied impermanent loss? And one way, and this is a bit the technical part of the paper, but it's unfortunately the only way of doing this, is by spread options. So you have a spread option, which is the risk neutral expectation of the difference between two prices, and you have this K, which is the strike. And then there is the literature on that, obviously, from Magrab, for example. And the trick here is to do a change of numeraire. So in order to price these options, one does a change of numeraire, and going from the Q measure, the risk neutral measure, to another risk neutral measure, which is called Q tilde. And this Q tilde measure looks like this. So basically, you divide through the second token, the numeraire, and that's why it's not there anymore. And then you can rewrite this, and it's now the expectation under the tilde measure of the relative price. So we already got one step closer to the domain we're interested in, which is the relative price. Then Girzanov tells us how these dynamics of P1 and P2 under the risk, which were stated under the P measure, look under the dynamics under the tilde measure. They look like this. And now if you remember how to value variance swaps, basically, or volatility swaps, it's basically through the lock contract. So what we do is we take each token and we apply these dynamics which now are the token dynamics under this risk neutral tilde measure, we evaluate this left-hand side. So we are interested in the variance of that token, the integrated variance under the Q measure, and doing some of these calculations, plugging in the dynamics, we can basically evaluate the lock contract for both of these tokens. Why is that important? Because ultimately, we want to replicate the expected impermanent loss on the left side, which is this thing on the right side, and then using the logarithm property, we can rewrite the thing on the first line to the one on the second line, and which then adds up perfectly to the lock contract of the relative price. So to sum up, the expected impermanent loss is basically the evaluation of the lock contract of the relative price. Now the question is, how do we get this quantity? And let's assume we would have a risk-neutral joint distribution for P1 and P2 for the two tokens. We could then, following this equation from a graph, construct a measure according to this rule, and we could then calculate this Q tilde measure, which we could use to value this thing on the right side, which is the expected impermanent loss. The question is, how do we get the risk-neutral joint distribution? And there is basically this Hansen-Jaganathan bound coming into. So this is a fundamental equation in asset pricing, and basically here we use it, we minimize the pricing kernel on the right-hand side. So the right-hand side motivates us to find the pricing kernel, which minimizes that bound. And we do some ansatz, the pricing kernel should look like this, and then we basically solve a convex problem, minimizing the pricing kernel of that, the pricing kernel, which gives us the Q measure, such that the risk-neutral boundaries, the univariate distributions are basically as we want them to be, and the distribution should be positive. So that's a second step. This gives us the Q measure. The Q measure then is transformed into the Q tilde measure, and we can evaluate the expected impermanent loss. So this is how we do it. We need the risk-neutral densities for the margins. So we take option surfaces for that, and we take real-world densities, and then we solve this. The details are in the paper. We can even go one step further. We can also calculate an equicorrelation from our risk-neutral measure. So the problem here, typically when you do equity correlation, you take this equation, you set it to fix rho, and you basically back out rho. The problem is on the left-hand side, you have the variance of an index. The variance of an index, there is no index on cryptocurrencies. So this equation can't be applied. So we need to do something else here. And what we do is, again, we use the spread options, which we now can calculate because we have the Q measure. So we can calculate the call, for example, a call on the spread option using our measure, which we got from the optimization. We can then back out an implied volatility, and we can use again McGrath equation to get an implied correlation between the two tokens, like in this case, Bitcoin and Ethereum. So this was really technical, but unfortunately important. So let me show you some numbers. So we get daily historical APRs, and we get this from the graph, from Uniswap v3, the largest 250 pools. This is how the impermanent loss on average looks over time. On the left-hand side, you see it over time. On the right-hand side, you see it average across time, the histogram for the pools. So this annualized, so this impermanent loss can be quite large. On average, it's like almost 10%. The APRs are over time look like this. So we saw a decrease recently. And on the right side, you see the APRs basically cross-sectional. Okay, this is basically just summary statistics. Now let's take a look at our measures. So we get this surface data from Deribit. We interpolate, we get risk-neutral distributions. These risk-neutral distributions we feed in our algorithm to get Q measure. We also calculate the token's individual volatility implied, which is the SVIX. We also calculate the implied correlation between the two tokens. And what we get is this picture. So the left side is the implied versus realized impermanent loss. And the impermanent loss is super noisy. It goes up and down. Actually, you don't see anything. So what you need to do is you need to smooth it. So the left side is a 30-day smoothing window, a smoothing filter. And you see the realized one is typically lower than the implied one, which is also what kind of you would expect. If you don't smooth by 30 days window, but by just 7, you also see that there are some spikes. And here you see that the realized impermanent loss of BTC ETH also exceeds the implied one. So there is a dynamic between the two, similar to if you look at the variance risk premium. Typically the Q measure is over the P measure, but sometimes it's the other way, especially during market turmoils. So this fits quite well, actually. The realized and the implied, they have like a correlation of almost 40%. Then we have the drivers of this implied impermanent loss, which are the implied volatilities. And here you also see the blue line is typically over the orange line on the right side as well. So there's a variance risk premium already discovered in these individual tokens. Yeah, this should be ETH here. So this is Ethereum. Now let's look at the implied correlation, which we were able to construct without an index on these basket options, just due to our optimization. And here also you see a great co-movement, and typically the implied correlation is a bit higher than the realized correlation, which indicates a correlation risk premium. Okay, so these are basically the measures we are dealing with. And in the next step, we search for some applications of these measures. And we also investigate some more bad days in the market, but this is, I skipped for today. The question is really are these measures able to explain the cross-section of liquidity pools? So what we do is, basically the question is, does a larger exposure to the risk factor, which are these implied measures, but also the realized measures, mean a higher return in the future? And one way of doing this is this by Farmer-Macbeth two-stage regression. And these are the results. So this is the realized impermanent loss. And basically, in line with the economic intuition, what I said at the beginning, a large shock to one of the fundamentals causes an impermanent loss and increases the APRs. So what this plot shows you is basically, typically you do this Farmer-Macbeth two-stage regression, and then for the expected returns on the second stage regression, you take, for example, the realized returns of the next month. Here, what I do is I take the realized return of the next day, the next 2 days, 3 days, 1 week, 10 days, 14 days. So everything works rather on a shorter horizon. So monthly future returns doesn't work basically here. And for the realized impermanent loss, you see that after 1 or 2 days, basically, there's no more relationship between in the two-stage regression. So there's just it's only really significant for short horizons. So this is what I said at the beginning, this economic intuition that the shocks and the impermanent loss, this relationship is there, but only for 1 or 2 days. So really short for a short horizon. So pools with more negative impermanent loss earn a higher premium, basically, risk-return relationship. Let's look at the implied impermanent loss under Q. And here I take always the same. I take, because you can only construct it for Bitcoin, Ethereum, because that's the only traded options, basically. And here we see that basically the decay, it explains the risk-return relationship up to 1 week. So the expectation using option implied information gives you better and more longer lasting result, basically. It's also positively, the price of risk is positive. So the pools with higher sensitivity to changes in the implied impermanent loss earns a higher premium. This is the implied impermanent loss. Let's look at the drivers. And here, for the implied volatility of Bitcoin, we get up even to 10 days. Ethereum, the same, also 10 days. Also positive price of risk. So if the volatility increases of one of the tokens, you experience impermanent loss. So this is in line with the intuition. What about correlation? And correlation is extremely interesting because it's negatively priced. And remember, for an LP, the worst thing which can happen is having a negative correlation between the tokens. Because if one goes up, one goes down, the arbitrageur enters and can basically take profit right away. So that's why the price of risk is also negative. So investors want to avoid basically negative correlation. And here, yes, the significance is not as great as for the others, but it's okay. Let's put them all together in a regression. And we see also this is in line. The implied volatilities are positively priced while the correlation stays negative. And together, jointly, the correlation even increases the decay up to 10 days. And it's almost also significant to 14 days. But I mean, this is not the point of the paper. Yeah. Okay. I don't show you the realized measures, but they basically give you worst results. They have lower or negative R squares. They're not significant. For example, the realized correlation doesn't work. And also controlling for token prices doesn't really matter. Token prices, if you add them, they're also just significant for 1 or 2 days. The results are also robust to shorter rolling windows. So I take 1 year rolling window to estimate the betas in the first stage regression. Also, I mean, the data it's 2 or 3 years of data. So typically asset pricing studies have 30 years or more. If you work with option implied, starts in the 90s. So everything is, yeah, keep that in mind, basically. Future research questions is what about the risk premium? Like really, what about the implied impermanent loss risk premium, BRPs, CRPs? How does the term structure look of these Q measures? Everything I showed you was for 30 days maturity. So because we took option from 30 days with 30 days of maturity because they're the most liquid ones. One could also extend this to 0 DTEs or even shorter horizons. And yeah, to sum up, basically, in this paper, we connected on-chain liquidity provision, which is returns and risks, to the derivative markets, so the centralized derivative markets, and how via this expected innovation in the token's prices. Therefore, we provided a mathematical framework which shows that this implied impermanent loss can be decomposed into these drivers, which is volatilities and correlation. And then we needed a few steps, a few tricks to basically value this expected impermanent loss as a variance swap under this new risk neutral measure, which allowed us then to value it. And therefore, then in the second step, we needed also to minimize some economic framework to get a Q measure, which we could then transform in this Q tilde measure to actually calculate these quantities and also to extract an implied correlation without any traded options on the index. We use then these measures we construct these measures then using traded derivatives. These measures explain and price the cross-section, and the returns and the signs are in line with economic intuition, higher risk, higher return, which is from the beginning again. And now I'm super curious about the discussion from Kirill, who is unfortunately wasn't able last minute to come. So he will give this discussion online. So let's see if that works.
Hello, everyone. How's my sound?
Hey, yeah, we can hear you. Do you hear us?
Yes, I do.
Perfect.
Well, thank you for this great presentation. Do you see my slides as well?
Yes.
Okay. So what I like about this paper that it talks about very important issue, and if you think about DeFi categories.
Sorry, just 1 second. Just 1 second. Sorry, could you please make it a little bit louder?
Hello?
No, I mean our IT basically. Can you speak again?
Yes.
Yeah, perfect. Thank you.
Okay. Yeah, so what I like about this paper a lot, that apart it's well explained, that it talks about very important issues in DeFi. If you look at DeFi and look at the different component of DeFi, then liquidity token and yield farming are significant component of DeFi. And it connects basically liquidity token, yield farming, decentralized exchanges to the derivative markets. And if you talk about these categories, you cover most of the DeFi innovation in terms of at least total value of the assets. So then what is yield farming? If you go, let's say, on Binance, you see that you can actually, by holding some cryptocurrency, you can earn significant returns. And this paper actually trying to explain like why we have these return differences. Now, let me quickly summarize the paper. So the paper starts with the solid theoretical concept and derive theoretical framework to derive a risk-neutral measure of impermanent loss. And then it uses this measure to study or provide a risk-based explanation for the cross-section of return and liquidity pools. And as Lorenzo explained, so where's the return coming from? Return coming from the fact that you liquidity provider earns part of the trading fee by providing liquidity to the liquidity pool. And on the same time, it exposes risk because it's stuck. It's exposes to the movements of the relative prices of token when it's put the tokens into liquidity pool. Then what they did very smart thing. They use a crypto option to estimate this implied impermanent loss. So obviously, like kind of on the basic principle idea to use price option to estimate volatilities are not particularly new. But here we need not to estimate volatility, but impermanent losses. And on top of it, as he mentioned, there are two big challenges. One, that you need to actually estimate joint density of two tokens from individual token options. And there is like in order to apply the option pricing, you also need to make sure that relative price involves as a martingale. And they achieve it by changing the numeraire. So on the data side, they take option data from Deribit, and as he mentioned that they focused on the most liquid 30 days options and liquidity pools. It's pools for various token pairs for any Ethereum base pair on Uniswap version 3. So I'm just I was expecting, I mean, given that even if you look at the future prices, there is a significant, sometimes there are significant difference between spot and futures prices, even for Bitcoin, the most liquid asset. So I'm just wondering, I was expecting to see some data on how liquid these options. And especially if, like, let's say we want to apply this methodology and go to the significantly less common pairs, like not Ethereum, Bitcoin, but slightly more exotic tokens. I would really like to see some measures of liquidities for the options. So then, regarding the results, the impermanent losses depends on the token return volatility and the correlation between them, and they show that Uniswap pools yield on average to the positive return and sometimes very large return. However, it exposes also to the large impermanent losses, on average minus 10% and reaching minus 70%. Now, so the methodology is solid. It was developed partially in the previous paper. And consequently, most of my discussion will be involved around the assumptions. not the execution. So first of all, when we think about decentralized exchange trading, like people seems to believe that like three things are, I mean, very related and important. One is this automatic market makers, which let you trade tokens, one token for another token on chain. Then there are also perception that without the adoption of the stable coins or introduction of the stable coins, this won't be possible. And in fact, if you look at the most of the pairs, it's some crypto pair against the stable token, most traded pairs. And in order to give incentives to liquidity providers to provide liquidity, you also earn some yield on providing this liquidity. So you decentralized trading also enables to people to get some yields or by lending the tokens. Now, there is so-called first generation of automatic market makers, which were first introduced by Bancor, and it was simply a product. So you have a units of token X and a token of Y, and we want to keep this product constant. And this was adopted also by Uniswap version 1. And so the issue with this automatic market maker specification, constant product market maker, that there is a price impact. So like you by supplying more tokens, you affect the prices, relative prices of the tokens in the pool. However, the benefit that there is infinite liquidity. Then another extreme is sort of constant sum market maker. One, you keep the sum constant. The advantage of this is that there is a zero price impact, but finite liquidity, and potentially the whole pool can be easily drained. So that's why the second one is not used at all. Then kind of next iteration, which is what Lorenzo used in their paper, it's the constant or geometric mean market maker. So which is basically like potentially we can have a different power, but like the simplest version, like square root of the product between the two. And this was adopted by Uniswap version 2 and Balancing version 1. So, and like the practitioners has long realized that there are these issues due to these market makers, particularly these impermanent losses, the fact that there is arbitrage between the relative prices of the pool and the market price, and potentially arbitrageur can extract profit at the expense of liquidity providers. There is another issue, so-called low capital efficiency. So liquidity providers has no control at what price they provide liquidity. And potentially you would like to have as much liquidity like when it's needed around the market price. So to address this issue, the second generation of automatic market makers were introduced. So-called hybrid, when you're sort of mixing between the constant product and constant sum, and this was used by stable swaps. It enables low price impact and infinite liquidity. Then there is a dynamic market maker, and what was used by Uniswap version 3, it's concentrated liquidity, constant product market maker. So here the idea is that liquidity providers not only choose to provide liquidity to particular pool, but also it chooses the price range, like PB to PA, at which it's willing to provide liquidity. So you're not only specifying that I supply this amount of token, but I supply only for the price range. And this increased liquidity near the current market price significantly. And also minimizes the price impact. Okay, so and basically my first question is like, since you use Uniswap version 3, which is now one of the most traded. So it's kind of natural to expect that maybe you want to check how robust your results to if you change the specification of the automatic market maker function. So then let's look at the pairs on this Uniswap version 3. And as you see, most of these pairs, like WETF, it's wrapped Ethereum, wrapped Ether against USDC, wrapped Ether against USDT. And so basically most of these pools, like the second token, one of the token is to the large extent is the stable coin. So, and if it's the case, which seems like data suggests, then the impermanent loss function, you only care about the volatility of Ether, not the volatility of the stable coin. I mean, there are some cases when there is deviation from the parity, but putting this aside, so, and in this case, you already have this option and of, let's say, Ethereum against USDT, and the liquidity pool also wrapped Ethereum against USDT. So you don't really need, for this case, your methodology. And then another question is, what do you do with the pairs when there is no option? Like, for example, the pair of the green Bitcoin or this the BMV. So another issue, like even like if you stick with your geometric mean loss function and assume that one of the coin is the stable coin, then changing the like power parameter alpha, like, so there is a X token to the power of alpha, Y to the power 1 minus alpha, and one, let's say one of the coin is the stable coin, so you care about only volatility of the changes in the prices of the Ethereum. So by changing this power alpha, you can see, so here I plot the permanent losses as the function of the relative price changes. So if you put a lot of weight on the stable coin, like 95% versus 5% on the Ethereum, then you can see that even very large price changes would generate very limited impermanent losses. Now, if you look at this calculation of IPRs, gross and net, we see that in the latest sample, the gross decline and net IPRs become a net. It's like IPRs minus impermanent losses. They become negative. So in this period, then you should expect some outflow from liquidity pool. And my question is, if it's indeed the case that you observe such outflows. So then more like fun slide about the title. So Lorenzo sent me two versions of the title, like in the slides and then in the paper they were different, and in both cases they were relatively long. So I had some issue like putting them into one line or even in two lines. So and then I found this funny article which says that in economic journals, articles with shorter titles tend to receive more citation and published in better journals. So like just think about it. Other than that, it's a well-explained paper that connects options to staking and yield farming, which is basically most of the DeFi is all about, but the word's slightly more complicated than the theoretical setup in the paper. Thank you.
Thank you, Kirill, for the great discussion. Yeah, let me answer really briefly. So regarding the liquidity, so Deribit, even though, yeah, Deribit is basically the centralized exchange with the largest liquidity, but yes, it's a good point. We should mention that and maybe also provide some summary statistics. Indeed, most stable coins, most of these pairs have stable coins as numeraire, but nevertheless, one challenge was to basically generalize this because otherwise it's a simple replication of the variance swap was exactly to generalize it for a token pair where you have two volatile tokens, so to say. Also the AMM, the assumptions we do on the product rule is the simplest rule, so to say. We worked on an extension using the concentrated liquidity and then replicating everything with corridor variance swaps. But as you can imagine, it's already quite some technical work. So then replicating everything with corridor swaps and carrying these concentrated liquidities indicators makes it even more complicated. But yes, it's a follow-up work basically. And regarding the title, as you saw, we already shortened it, and maybe then, since you're saying we should even shorten it further, that's a good suggestion. So thank you for the discussion.
My pleasure.
Okay, maybe we have.
We can move to the second presentation.
Yeah, maybe one or two questions from the audience. Is there something?
But we said earlier that if the arbitrageurs enters the pool, then the impairment loss is higher, but then also the return will be higher. So we are not just kind of trade-off. And I was wondering whether the results actually depends on the size of the pool. So the more arbitrageurs enters in this pool, maybe I didn't get it from the presentation. But I'm just wondering whether your results, will depend on the size of the pool, for example, whether this will change, or at some point of limit there will be a threshold of arbitrageurs, and it's just, So this would be the questions.
The person who can answer that best is probably sitting behind you,
Yeah,
but
yes.
Nevertheless, yes, that's indeed important, and we didn't look into it yet.
Okay.
But it's a really good comment, and it matters actually. For now, we just do cross-sectional. We take everything, but I didn't control for size yet. But yes, it's true. And then Roman, one last question. Sorry.
Thank you very much. It's a great presentation. I just wanted to clarify, because the technical aspect was flashed very quickly. I will have to probably read the paper, but how much is your model of impermanent loss is model free? Because you started with the simple Brownian motions with a constant drift. I mean, how critical is that assumption? Thank you.
That's hard to tell. So you mean under the P measure or under that's.
You do have a lot of mean reversion in those prices beyond just simply permanent price, permanent Brownian.
But these are the token prices, right? For the P measure, yes. So you would suggest another process for it, for example? I mean, we could include jumps, for example, which might be a realistic assumption as well. But no, I mean, we never tried it outside this framework, because so far it's tractable, obviously, and we can push through the end. But
The assumption is that it's significant. Might put more correctly the significant entities or indices, but that's essentially the assumption. Could add.
Thank you. Okay, then I think we should move to the next presentation.
Okay, the second presenter is Roman Kozan from Warwick Business School. He's going to present a contribution, price discovery in cryptocurrency markets, trades versus liquidity provision. Okay, you have 25 minutes for presentation.
Good morning, everybody. Thank you for inviting for the conference. Thanks, Lorenzo. Thanks, organizers. It's a really great program, and it's really an honor to be here. Okay. So the paper is joined with a bunch of my co-authors from Warwick. So Olga Klein, Ganesh Viswanath Natraj, and also Jun Schwan used to be at Warwick, PhD student, but now he moved to Judge Business School. So let me start with the motivation. So when we think about generally organizing exchanges, when we think about the trading process, the information is one of the key aspects that we tend to think in finance. So we always worry and care about how quickly and how precisely information builds up in the prices, so that the market that we are trading in is what we call as efficient as possible. So any uninformed trader who does not have much of the access to information, or doesn't have much of the ability to process information deeply, would not be so much concerned. Prices are correct and reflecting the fundamental value. And so we know quite a bit already how the information has been transmitted in the traditional markets. For example, large chunk of the markets are organized as a limit order book, and we have several papers showing the contribution of different types of orders that contributes to the price discovery, some market orders, limit orders. Now with this introduction of this Uniswap and automated market makers, not necessarily only Uniswap, but generally other platforms, give a rise of introduction of these AMMs, which is very different type of trading mechanism. And so these markets have been already analyzed from different perspectives. So for example, Alfred and Christine has this nice paper talking about comparing the liquidities, about the organization of limit order book versus automated market makers, and so on and so forth. But also the question is how the again, what is the role of price discovery in these sort of markets, and if you were to compare with the limit order book? Now, when we look specifically, zoom in onto Uniswap v3, so what Uniswap v3 is doing is introduced a new range of functionalities for the liquidity providers. When you think about the Uniswap v2, so all happened there, liquidity provider would be like very passive. We submit liquidity, we could potentially withdraw at some point of time, but that's pretty much what a liquidity provider could have done. So with the Uniswap v3, a liquidity provider now can specify the price range where they could provide liquidity in a around specific prices, which gives more role and more active role essentially in this new reincarnation of the AMMs. And the question is whether this activity pays or whether the liquidity providers do pay more information to the transmission of information in the markets, and whether they use this flexibility and this functionality to time essentially their liquidity provision. An interesting aspect is that the Uniswap v3, when they were designing this new platform, hasn't been thinking about in terms of price discovery or market efficiency or so. So the main purpose is really increasing allocational efficiency of the liquidity, and perhaps reduction of the trading fees on those platforms. And so the question is, as a byproduct, does this functionality also leads to the greater price discovery in the AMM relative to the limit order book? And essentially, that's the main question that we are asking. So does liquidity provision in the Uniswap v3 convey information about the future prices? Sorry, which direction I'm going? I think it goes one. Okay, sorry. Coming back. Okay. So the paper relates to the literature where there are several theoretical literature trying to understand the motives for informed trading in the AMM, and there are several theoretical as well as empirical papers who are already looking at the decision making of informed traders in the limit order book versus AMM, and so on, as well as different type of literature trying to understand determinants of liquidity provision across different exchanges. So we are somewhere in between those two strands of literature. So what we do here, we are trying to, while our main focus is on the decentralized exchanges and liquidity provision and actions of liquidity providers in decentralized exchanges, we also have to control for information that has been conveyed by decentralized exchanges. And so, in a sense, it's in some sort of a comparison between limit order book and the decentralized Uniswap data. So in the centralized exchanges, the data is organized in the limit order book, where there are type of orders that are typically well understood, market orders versus limit orders. And in the decentralized exchanges, so as we know, they're operating on the blockchain using smart contracts. The automated market maker essentially is purely deterministic price determination rule, which will essentially exclude to a large extent the setting up price rules by liquidity providers. And in terms of orders that investors can use, so typical orders would be the swap orders, which is resemble the market order. So people would just go and exchange one tokens at the other at the price determined by the level of liquidity in the protocol and the and this deterministic price rule. And then liquidity providers would be able to have two types of orders: minting or burning tokens, so essentially supplying liquidity or withdrawing liquidity, again resembling new limit orders arrivals versus cancellation of limit orders in the limit order book. And also there is a new parameter which specifies where exactly you want to deposit this liquidity, closer to the price or further away from the price. So I put this slide at the end of the presentation for some reason, but I can just flash you very quickly. So essentially, with the new liquidity, this price range tools, this automated market maker, liquidity can be more resemble like a limit order book. So where you would have different price ranges and you can supply or withdraw different liquidity at different point of time. So which gives now the distribution of liquidity in these protocols. Sorry for the, you've seen this presentation already. Okay, so data. So we use one particular currency pair, Ethereum USDC. So which is the pair which is by far has the biggest activity of liquidity providers orders in the data. And so we consider two different pools in a DEX. We know DEX 5 and DEX 30. So there is a high fee pool and low fee pool. So liquidity providers can get different types of pools, fees in those pools. If they go to the DEX 5, so they would earn 50 basis per trade, and then in DEX 30 they would earn 5 basis point and the 30 basis points respectively. So in terms of summary, very quickly, so we probably know that from other papers, but the DEX orders are by far larger compared to the centralized orders, about 10 times magnitude bigger. Also, the trade size per trade are again significantly higher than in Binance. And although in terms of number of trades, you can see that in the CEX market, orders coming way much more frequently. In terms of liquidity provision, we have a similar situation. So any liquidity supply is much bigger in terms of depth. The market DEX are much bigger in terms of depth. Although there are many more minutes where the liquidity provision has been supplied in the centralized market relative to the decentralized market. But again, in terms of the volume, given that liquidity trades are much bigger, so the DEX dominates in terms of liquidity provision in the CEX market. Okay, so in terms of methodology, so to understand the price discovery process and so whether any kind of orders, any actions in the market, whether it's aggressive order or passive order, convey any long-term information. So we employ simple standard VR method by Hasbro, where essentially we are estimating whether the shock to any type of order flow will have any permanent or long-term impact on the returns. And so here we have different types of orders. So we have swap orders or market orders, and we have liquidity orders, which we split into the mints, burn order flow, limit order flow, and also we separate them in terms of where this liquidity has been supplied, close to the current price or far away from the current price. And so here in this example, we use some sort of a standard ordering of the order flow. So again, we're assuming that the orders in the CX market can contemporaneously affect the returns, but not vice versa. And to do inference, we employ some wild bootstrap methods. So here's the results, the baseline results. So first of all, here I'm showing you the price impact, or 30 minutes price impact of order of the 1 million USDC shock to each of the order flow. We can see that the long-term price impacts for all three types of aggressive orders, whether it's a market order or swap orders in the DEX or DEX 5 or DEX 30, have a statistically significant and positive price impact. So orders pushing prices in the expected direction. So buys would push prices up and sells would push prices down. So limit orders have also significant price impact. Again, this is consistent with Brogard et al. Results that the trading can happen. So the price discovery can happen without trading. So simply by posting and withdrawing liquidity. Limit order at the best has a negative price impact, which is what it means is if we submit more liquidity at ask, we would expect price going down. And if you submit more liquidity at the bid, price would go upwards, so opposite direction, which is what is expected. So somewhat surprisingly, the limit orders which are outside from the best price would have opposite permanent price impact. So which means that even those traders who observe that their liquidity becomes stale, they cancel or, for example, their orders still anticipating like long-term price impact, but the price impact is smaller. Now, when we move to our main points of interest, so mins and burns. So again, I want here to note that limit orders have some ability to move prices mechanically. So when you post, when you undercut and post limit order which is above the current, let's say, bid, it not naturally moves the mid quote of the price mechanically. And also, if you're canceling the best limit order book, the best limit order, the price might drop or go up depending on which side of this. The liquidity orders in the DEX has no ability to mechanically move orders whatsoever. So whatever we're looking here is pure anticipation of the price given. Either they have a private information or they are quicker in processing any sort of public information. And so what we see is indeed that the mins and burns do have informational content. So mins has this negative price impact, which is similar to the limit order. So if you're minting something below the price is expected to go upwards. Burns have opposite effects. So when you burn something below the price, you expect price to move towards the where you burn your price. What you can see is only the best orders have convey information close to the current price, and main information content is happening on the low fee pools. Again, it's somehow expected because in the low fee pools, liquidity providers have greatest incentive to manage their liquidity, given that the reward they get is the smallest and they are much more exposed to the impermanent loss in this pool. So in the DEX 30, they have a bit more flexibility. They can allow to be a bit more passive in that aspect. So in terms of just to visualize what kind of strategies they can be employing. So here I put here P0 as a current price, and let's suppose the future price will be P30. So in this picture, price goes upwards. Minting liquidity close to the current price would mean that, okay, I'm less worried now about price dropping, so I have information that price permanently will go up. Now I can afford to put more aggressive liquidity. I'm not really worrying about the impermanent loss. On the withdrawing aggressive liquidity, I might be actually having some information about pricing permanently moving up. So let me quickly withdraw my liquidity ahead of that's happening. Now, in terms of orders which are away from the best price, we can only see some significant effect, small and significant effect for the burning away orders, again, which might be consistent with some sort of reallocating stale liquidity. So I anticipate that price will move away from my quote, which is already far away. So chances that I'll get any fees traded for this order is almost zero. Let me burn it here and perhaps relocate it somewhere closer to the current price. And again, we don't see that in the DEX study. So here is just again some simple visualization of that happening. This is just an example of the cumulative price impact responses of the order flow. So clearly the aggressive, the swap orders are much stronger, while the mints and burns are a bit smaller, but still statistically significant. And so we do a bunch of other exercises to see what types. 5 minutes, great. Thank you. What types of orders, when we slice more in terms of characteristics of either orders or wallets that convey more information in this market. And so first exercise that we do is to see whether the priority of execution matters here. So we look at the orders which happen to be at the top of the block, so in terms of the priority. So this can happen because of several reasons. So either some of the liquidity providers tend to pay a higher gas fee to expedite their orders to be included in the block, like in the style of Capone et al. 2022, or could be done by the bots who essentially bypass a mempool and essentially have direct arrangement with the miners to be included, their orders to be included into the block. So essentially, we're looking at the position, and we see whether the orders that happen to be the top priority of the block has a higher informational content versus to those which are in the bottom. And so here are our results. So the upper panel would have top order flows, top position order flows, and the bottom panel will have bottom position order flows. And indeed, we can see that, well, so best, top, and burns, they still have information content. The burn top, which is away from the fundamental, from the current price, also has some significancy. The best orders that are in the bottom actually do not really convey as much information as we have seen in the top orders. Then we slice orders by size, looking at the large liquidity provisions orders versus the small orders, and whether there is any differential information here. And indeed, we see that the most of the information content coming from the large orders than the small orders. We look at, in terms of the wallets where they are deemed as a pure liquidity providers, and their only activity in terms of submitting or burning, minting or burning orders, or sometimes we see that there are aggressive swap orders coming from them. So in that sense, we call mixed strategies if they are both using swaps and liquidity provision and switching their side versus being pure liquidity provider. And we can see that the most information coming from the wallets that have mixed activity, not just pure liquidity providers. So these are traders who are timing either they're being liquidity providers or trading aggressively. Finally, we're also looking at the repositioning strategies. So whether the information coming from the orders which burned their liquidity orders and then simultaneously minted very quickly afterwards versus some other type of strategies. And indeed, the information that comes from the best orders are coming from those orders which are repositioning. So investors, so liquidity providers do tend to monitor markets, trying to extract as much information and actively repositioning liquidity, perhaps to either get higher fees in the future or avoid impermanent loss. And finally, we look at the frequency, how often they reposition, and here we didn't see any clear message. So essentially, the results are a little bit mixed in here. Final slide, promise. So variance decomposition. So we look at how much of the variance of the returns, long-term returns, has been explained by different types of orders. And although we did find that there is a permanent price impact coming from different orders, liquidity orders, minting and burning, aggregate, they don't really explain too much of the variation in the returns, particularly because of their fraction relative to the number of swap orders is very, very small. So they're not really contributing so much in total. I can skip this. So that's what we do. We're looking at the price discovery and where it happens in which of the market and in which type of orders. And so we see that trades and swaps do contribute to the price discovery in both markets. And so we will see that Uniswap with 3 considered liquidity provision orders also convey information. So this additional liquidity functionality that Uniswap v3 has introduced has led liquidity providers to be more active, and their orders do convey information in the Uniswap v3. Thank you.
Thank you very much for presentation. So the discussant is Eric Thyssen from University of Mannheim.
Okay, first of all, I would like to thank the organizers of the conference for inviting me. It's my first time in Torino. The weather could have been better. So it's a pleasure to discuss this paper. It's a very interesting paper that adds an important new perspective to the empirical literature. So let me very briefly summarize the paper. So essentially it looks at price discovery in centralized exchanges versus decentralized exchanges, where the centralized exchanges are essentially just standard limit order books. And so there are essentially two questions. The first is which of these types of exchanges provides more information for the price discovery process? And then secondly, and that's actually the new perspective I was mentioning, what is the relative contribution to price discovery here of first trades or swaps in the decentralized exchange on the one hand, and liquidity events on the other hand. And liquidity events in the centralized exchange are, of course, just a submission and cancellation of limit orders, while in the decentralized exchange, it's the minting and burning of liquidity in that V3 pool, which allows for that concentrated liquidity. So the methodology here in the tradition of Hasbrook is a vector autoregressive model. And the main findings are that as far as the decentralized exchange is concerned, price discovery is mainly through trades or swaps. Then liquidity events on the decentralized exchange do have a price impact, but it is smaller than the price impact of limit orders on the centralized exchange. And then finally, there is evidence of active liquidity provision in the decentralized exchange. So what will I be talking about in my discussion? First, I will talk about the elephant in the room. There is one. Then I will talk about the mempool, and then I have some comments which refer to some details of the papers. So as I said, there is an elephant in the room. What's the elephant? Well, we're talking about price discovery, and it's very explicitly stated in the conclusion that one question that you're addressing is whether decentralized exchanges have more information for the price discovery process compared to traditional markets. And then we have that analysis looking at these specific event types like swaps and trades in the centralized exchange and all these liquidity events. But the overall question, whether the centralized or the decentralized exchange has a higher share in the price discovery process, that question is actually not addressed. So while you read the papers, I was constantly wondering, so why do I get these information shares or common factor weights or whatever? Now, the big question is, well, how big is that elephant? Well, we have papers on the relative contributions of price discovery of centralized and decentralized exchanges. Most importantly is a paper by Carlo Alexander and co-authors, which you also cite. And without going into the details here, essentially that paper concludes that the contribution to price discovery of Uniswap is very small. So therefore, there is an implicit tension here in the paper that on the one hand, the reader in the back of his or her mind knows that, well, maybe the contribution to price discovery of decentralized exchanges is small. But then we see that analysis which looks at the components or the determinants of that, like the liquidity events and the swaps. And I think that is something that would need to be discussed more explicitly in the paper so that you can somehow remove that tension from the paper. And the second thing I would like to talk about is the mempool. So in the mempool, there is essentially information on impending swaps. And that information can actually be used. So on the one hand, we have essentially these sandwich attacks, which is just a form of classical front running. And maybe more relevant in the present context is we have these liquidity sniping events, where essentially someone sees, or an algorithm sees, that in the mempool there is essentially a large impending swap which will move the price, and then someone essentially comes and provides liquidity for that by essentially minting liquidity. Then the swap is executed, and then the liquidity is immediately burnt again. Essentially, the motivation of doing that is essentially to earn the fees that come with a large trade. And because that liquidity would essentially be provided in a very small price range, meaning that the sniper has the largest share of liquidity provision in that price range, essentially gets the largest part of the fees, and that's essentially the idea of doing that. So why and how is that relevant in the present case? Well, with that liquidity sniping, essentially, when you look at what actually happens in the marketplace, then somehow the order of events gets distorted, right? Because we first have the swap in the mempool, but then actually the mint is executed first, and then we have the swap, and then we have the burn event. But actually the mint was caused by the swap in the mempool. So as a consequence, first, the recorded sequence of events in the marketplace may be misleading, and events here may be contemporaneously correlated. Actually, the fraction of the sniping attacks in Uniswap is actually quite large for large trades. So maybe that's a point to discuss in the paper. And then, as I mentioned, I have some more minor comments. First, the entirely analysis is done on a 1-minute frequency, well, that may or may not be optimal. I'm not saying it's not. I'm just asking whether it is. And a reasonable alternative, to me at least, may be something which matches the block time on the Ethereum blockchain. Then secondly, you categorize these mint and burn events as either being on the bid side or the ask side. But of course, we can also mint liquidity in a price range that actually spans the current marginal price. And I didn't understand how these would be treated, whether they would be omitted or how they would be allocated to the bid or the ask side. And if they are omitted, then the question is how many of them are there, and what's the implication of omitting them. Well, one important part of the analysis is to see how all these events actually affect returns. And if I understand it correctly, the return here is essentially the lock price difference from the centralized exchange. And that essentially raises two questions. Well, why is the price taken from the centralized exchange? And secondly, why is it based on transaction prices and not on quote midpoints? Again, I'm not saying that quote midpoints would necessarily be better, but at least it's a reasonable alternative. In particular, since the quote midpoint is a direct analog to the marginal price from the decentralized exchange. Then the last slide that you showed during your discussion is a variance decomposition, and that's the table that you just saw. And in the paper, the numbers in that table are actually interpreted as percentages. Yeah, so for example, the paper says swap orders contribute around 25% to price discovery, and that relates essentially to the sum of the, well, yeah, the point it doesn't work. So the sum of the 9.91 and the 14.50 here. But if these are percentages, then it's not entirely clear what are 100% here. This is the first thing. And secondly, at least on the face of it, these results then are again in contrast to what we know from that Alexander and co-authors paper, because if you take these numbers here at face value, they would essentially tell you that the lion's share of price discovery is in the decentralized exchange, while this other paper has essentially concluded the opposite. Final remark, and that is really a detail on the paper. I just copied that from the paper. It's on one of the assumptions made in the for the VAR model. We assume zero contemporaneous effect across swap, mints, burns, and market and limit orders. This is a safe assumption to make, as liquidity providers often burn and mint liquidity simultaneously, making it difficult to determine the order of causality. trading volume and liquidity provision are jointly determined objects, and it is a challenge to determine the feedback dynamics of swap and liquidity order. But these are somehow two problems, and these two problems will make it necessary to make the assumption of zero correlation, but it's not clear that they make that assumption safe. So that's all I have to say. Thank you very much.
Thank you very much for the discussion. So please, Roman, you can reply to the arguments made by Eric, and then we can collect some questions from the floor. I have also one question for you. Yes.
Thank you very much. Thank you very much, Eric. It's a really great discussion, and you spot on all of the issues that we are still debating with our co-authors. I'm not going to go too much into the details, so they're very useful and spot on. So what I wanted, I mean, the biggest and the most, okay, so variance decomposition one is just simply we didn't really put in the paper the variance that come from the past returns themselves, and they kind of count for the big majority of percentages. So they do sum up to 100. It's just the so the biggest problem is, yes, we are trying to show that our ordering assumption is robust. The problem is that one way to resolve that is actually the following, like Caponija and you, in a sense that they do all possible ordering combinations and essentially show the upper and lower bounds of these price impacts. Given that how many variables we have, it will run for a couple of months if you want to do all possible rotations in our setup. So we've done a couple of like randomly chosen ordering, and the results seem to be robust, but I cannot really claim or prove at this stage that it is indeed survive any sort of ordering. But that's exactly what we are currently working on, and that's important. And I agree with you in terms of minute frequency. We do have results on a block frequency. Result again similar. The reason why we wanted to aggregate is just because a number of these liquidity orders are fairly small relative to the aggressive orders. So we felt like in terms of VAR, so we're having only few events relative to, I mean, aggregation essentially mitigates that problem. But your point is obviously valid and well taken. Thank you.
There are questions from floor. So I have one small suggestions for you, is just to solve the last issue made by the presenter, by the discussant. So essentially the problem of the identification can be very serious in DeFi, because everyone is very fast, and so trading prices move quite simultaneously. I think it can be useful to abandon, for example, the recursive identification scheme, and for example moving to other identification schemes. For example, if you have in mind to capture supply shocks in the market, because orders essentially are supply shocks in the market. So burn or mint essentially withdraw or add the liquidity to the problem. You can use, for example, some restrictions, for example, between prices and quantities. You can identify demand and supply shocks, and maybe when you're going to calculate the variance decomposition, probably you can also obtain a large fraction of the variance that explains by the shocks, and probably also the interpretation of what we are doing probably is well clear cut. Thank you very much.
That's excellent. Actually, I'm reading a lot of macro literature now, trying to learn more about the identification schemes. Thank you very much. Oh, you have a short question.
Why is your data ending in 2022? Is there a particular reason for not updating it, or just?
I will have to check with my co-authors. Probably this is where they start working on the paper initially, and but we need to update.
Okay.
Okay. Thank you very much for your contribution. I think we have a coffee break now, so half an hour coffee break, and so we come back at 11:30. And thank you for attending this part of the conference. Thank you.
Go ahead. Yep, perfect. Okay, thank you. Thank you for having me. And just a quick disclaimer, these are my views and not necessarily those of the Bank for International Settlements. And this paper is joint with Giulio Cornelli, Leonardo Gambacorta, and Alessio Reghisa from the ECB. So just to get into the motivation and what we're thinking about here is we're interested in thinking about DeFi lending. And I think the very first and just sort of high level motivating factor for doing this research is just trying to understand, you know, why people do DeFi lending. And you know, we can think about why depositors deposit funds, and we're going to talk about that. And that's sort of, I think, an easier question because they earn some money for doing it. But there's this over collateralization that occurs. And so this idea that I have something of value that's more than the amount that I'm going to borrow seems like a little bit of a puzzling thing. So we want to think about the need for over collateralization. Why do we borrow through these protocols? And then we're also going to talk a little bit about the differences between what we call retail investors, which are sort of small value investors, and large investors, and all of this is with a mind of thinking about the way financial intermediation is going to evolve in these type of markets. So markets where people are anonymous, which is of course very different than the way we think of in conventional markets. So what are we going to do? We're going to examine the motives for DeFi lending protocols using data from the Aave Volume 2 protocol. We're going to look at deposit transactions and borrowing transactions as separate, or the motives as being separate, even though of course people do both. And we're going to propose a little bit of a theoretical model to justify the hypotheses that we test empirically. So we're going to try and identify the circumstances under which someone would do these over collateralized loans. Okay, so what do we find? We're going to show that deposits are by and large driven by search for yield. So people are doing this to get returns. And of course, what I mean by that is we have to think about what they can earn on a DeFi platform versus in traditional financial markets. We're going to show that borrowing is primarily driven by speculative motives. And what I mean by that is that if we think about what it would take to be wanting to borrow in a DeFi lending protocol, then we're going to argue that generally speaking, there has to be some type of expectation of future price increase. Okay, that you believe prices are going to go up, and therefore you want to essentially borrow collateral, or borrow the coin that you want to use to invest versus just sell the collateral that you have and just invest it directly. So there has to be some expectation of price increase. We're calling those essentially speculative motives. And of course, there are also benefits to staking, but we're going to argue that that necessarily isn't necessarily an incentive, a direct incentive for borrowing, and I'll explain that. As I said, we're going to look at this in general context, and then I'm going to give some distinction between the behavior of different types of investors, in particular, as I said, retail and large investors. And we're going to argue that retail investors' motives are really driven by the interest rates in the real economy. So it's conditions in the real economy being bad or driving these people into these crypto markets to get the returns there. Whereas large investors are less sensitive to that. In many ways, one can interpret this as being the idea that the large investors have lots of money in the crypto world, and they're really moving it around in the crypto world versus moving it from the real world into the crypto world. And so these investors are driven more by returns within the particular DeFi protocols versus a comparison of these returns with returns in comparable returns in financial markets. Both retail and large investors are driven by, as I said, these speculative motives. They have to believe there's some idea of price increase. And then retail investors seem to be very non-sensitive to governance benefits, whereas large investors are it's more important of an incentive. What I mean by governance benefits is that when you purchase some crypto assets, you get benefits in the form of voting benefits in some cases, or sometimes you get reduced fees and things on the platform that issue the tokens. Okay, so putting the research into context, there's a large, not a large, I guess already a large, but very quickly evolving literature that's analyzing DeFi and borrowing and lending in DeFi markets. I won't spend too much time talking about it here. A lot of this work is empirical, looks at different aspects that are complementary to what we're doing. But I will say that there's one really nice paper by Jonathan Chu and co-authors, which looks at whether or not borrowing and lending makes sense in a world where the borrowers are anonymous. And I think this is an interesting paper, I think it looks forward to thinking about a world where DeFi markets are doing something that's more close to what is done in conventional markets or conventional intermediation. That is, where borrowing is a process that's matching people with projects and no money to people with no money and projects. But that's not what we're really seeing in the DeFi world, right? We're really not seeing this matching of people who need funds to people but have projects and people who have funds but don't have projects. Instead, it's hard to understand what the borrowing is for, and that's kind of what's driving this research. So in the Chu paper, they're looking at, in a world where we're trying to do conventional financial intermediation, but people are anonymous, can it work? And as I said, I think that's a very useful question, but it doesn't, to me, really get at the heart of what's going on with DeFi lending in today's world. I don't typically see the connection between DeFi lending and funding projects. Okay, so we'll try to talk about some alternative ways of thinking about that. Okay, this is just a quick plan. I'm going to talk about traditional financial intermediation versus DeFi lending, a little bit about the data. As I said, we'll look at borrowing and depositing separately, and a little bit about large versus retail investors. So what's going on in these DeFi markets that's different than what we think about in traditional borrowing and lending markets, the traditional financial intermediation that we see in the conventional economy? So one thing is we have this anonymity and lack of credit assessment. So we don't know who the borrower is. We don't know what their reputation is. We don't know what their likelihood is of paying us back. So we can't do a conventional risk credit assessment. Crypto assets are the key collateral. So we're not putting up things of physical value, but we're putting up assets that themselves are highly volatile in terms of value. And then, of course, we have automation and smart contracts, right, that facilitates this borrowing and lending process. So the rules of borrowing and lending are predetermined by these smart contracts. This, of course, all leads to this idea of over-collateralization, right? The idea that if we're going to issue a loan to someone we don't know, and if the assets that they're going to post for collateral are highly volatile, then we're going to ask them to post a lot of it. Okay. One of the other things that's different in these markets is the loans aren't typically for a fixed period. So whereas you typically, when you do a borrowing contract, it will be over some term. These lending pools generally are open-ended. So the time period at which you borrow and the time period at which you have to pay back are open-ended. But the contract, as I said, is governed by this idea of a health factor, which makes sure that you're always above water. And so, roughly speaking, what the health factor is, it's a ratio of your assets to your liabilities. The assets are haircut, so it takes account of the volatility. So you have these haircut assets, and you have liabilities, and the liabilities include what you borrowed, but also over time it includes the interest that you owe. These things are all priced in terms of a unit of account, typically Ethereum. And so you've borrowed in some other currency possibly. So all this stuff has to be adjusted for exchange rates and so on. And the key is that this thing can never drop below 1. If it drops below 1, then people can swoop in and buy out your position. Right? So that's one key difference. So as I said, we're using the data from the Aave protocol, starting in December 2020 and going through mid-July 2022. And this is just some summary statistics of the data, just showing you the number of observations, the mean transaction level, standard deviation, and so on. And this is just showing you an interesting breakdown of what people are actually doing in these lending protocols. So what they're depositing and what they're borrowing. So as you can see, by far the most common deposited form of collateral is Ether. So this is on the Aave protocol. So this is wrapped Ether. And then what they're borrowing is mostly stable coins, but also other various coins. Okay, just interesting to see the breakdown. Some of the financial variables that we'll use in the regression from the conventional economy are the yield on US Treasuries. We also make use of this crypto fear and greed index. So this is quite an interesting index if people aren't familiar with it. It gives you an idea of what sentiment is towards crypto investing. It's based on a large collection of things like Google Scholar searches, variants of crypto prices, the dominance of Bitcoin, just a variety of things, surveys, just a variety of things that would factor into how people might think about crypto at the time. We keep track of whether or not a token that's being deposited or borrowed is a governance token. That is, does it have some governance benefits? Either voting, as I said, rights, or sometimes reduced fees. And then, of course, we have to keep track of when those are active. And so then the first thing we do is we look at demand. So there's no real model here. I mean, these are people are, we're just testing what, whether or not there's a search for yield and how that depends on other factors. So we have a vector of various variables that are trying to capture the types of returns that you can get in the conventional economy. So the Fed funds rate, yield on treasuries, and so on. As I said, we also put in this crypto fear and greed index, which is another measure. Things to do with the variance, so volatility and user fixed effects. And the first result is just that if we look at the pool of borrowers, or sorry, of depositors, without differentiating between the size, that is, if they are retail or large, then we find we find the response we'd expect with respect to the real variables. So if the real variable's low, then you're more likely to be looking for yield on these crypto platforms. The crypto fear and greed index also factors in. It's going to be correlated to some extent, but it factors in. And then the current price volatility also matters. So all these things are determinants. And I'll come back to this in a little bit to talk about how that breaks down differently if we divide between retail investors and large investors. And then this is just kind of, I think, an interesting plot, which is where instead, if we think about the fact that, we can try to capture the influence of the current rates on people's behavior, but that doesn't capture sort of dynamic effects like their expectations for future rates and so on. So this is just I think, kind of a cool idea where you just put in month fixed effects. And so that's, sort of capturing all of these things that vary by months, because we know what those months are like. So we can break down the periods into the period when we had, low inflation and low interest rates, right? And so, then it's all relative to December 2020. So then these are depositor flows, inflows of deposits. So these are relatively high because you're getting very little elsewhere. And then as we move into periods where people are expecting tightening, right, interest rates to rise, so we start seeing, less deposits. And then when we get to the period where interest rates are actually high, we get even less deposits. So it's a nice sort of shows the sort of transition of the movement into the crypto world, out of the crypto world as not only interest rates rise, but as expectations of interest rates rise. So we move into different regimes where people expect higher interest rates. Okay. Now let me talk about the borrowing aspect. So as I said, for me, this really started off by thinking, okay, why is anyone doing this? I first hear about a lending pool. You have to post, more value in collateral than you're going to borrow. Why would anyone do this? And so here's the basic story. So we think about what we're really going to think about is sort of two possible scenarios. So in both scenarios, you hold Ether. So that's your starting point. So you're a person who holds Ether. And let's say you have an investment opportunity in another coin. Okay, so some staking opportunity or some way to earn money on a different coin. And so what are your choices? You could sell that coin. You could sell your Ether and invest the new coin. That's one thing you could do. Call that coin A. Okay. Another thing you could do is you could borrow coin A. Maintain your ownership rights of Ether and borrow coin A and earn the investment off of the borrowed coin. Okay. When would you do the latter instead of the former? Okay. That's what we're going to explain. So as I said, one of the key things to remember is that when you borrow coin A, you don't get to borrow the full amount. You have to over collateralize it. So there's this loan to value ratio. So it's like, say, 0.75. So in other words, if you want to borrow 75 of coin A, you've got to stay in Ether value. You have to deposit 100. Okay. We're also going to make it this a simple discrete time. It's just an example to illustrate. So as I said, these loans are typically open-ended, but we'll just make it discrete time. So you're thinking about doing this for one period, and we're going to price everything in dollars. So we're going to compare the dollar returns, everything in dollars before and everything in dollars after. Okay. So we're going to consider these two borrowing options. And so when you do this, if we think about, first of all, the idea of borrowing coin A, then you're going to have some net return on your initial investment, which reflects the fact that you have to loan to value ratio of 0.75, and then you're going to earn some interest on the coin you borrow, but you're going to pay some interest for the loan. You're going to have some reward on the deposited collateral. These protocols pay you D, say, for the deposited collateral, and then you're going to have some, when it's all said and done, you're going to have some capital gain or loss. And if you want to add in the governance benefits, we do that in this way that's multiplicative. It's not the only way you could do it, but it's just one way to do it. So you introduce these governance benefits that occur to the borrowed coin. So we're imagining that you're getting the governance benefits from coin A, the coin you're borrowing. As I mentioned, there's also this risk, this idea that you could get liquidated if the price falls. So that's going to, you start with 1 unit of collateral, by the way, 1 unit of Ether. So you have your initial health factor. It's going to get haircutted by 0.8. And then 0.75 is your borrowed amount. So you start off with a health factor that's slightly above 1, but then the prices evolve. And at any point in time, your health factor could drop below 1. Essentially, that's going to happen if the value of what you're borrowing becomes less valuable relative to Ether. Okay, so if what you're borrowing becomes less valuable, then you could end up being liquidated. So we have to factor in that probability, and we just end up with some big expression that gives you the overall expected payoff to borrowing. And again, it's computed as a round trip, so everything's priced in terms of dollars at the beginning and dollars at the end. That's where the capital gain comes in. So you start with Ether, you have to sell your Ether for dollars at the very end, just so that we have a consistent way to evaluate the benefits. Option 2 is that you do this round trip. So you just sell your Ether and buy coin A and invest coin A. So that payoff is much simpler. You still get the governance benefits from coin A. But now you're giving up Ether. So now you're not getting the potential price increase in Ether. That's the trade-off. So borrowing is preferable to the round trip if and only if this expression holds, and it's just comparing the one payoff to the other. And after some rearranging, we get the expression on the bottom. And it's kind of interesting to see this, because one of the things that you can see immediately is, so you can see how it depends on your price expectations. Okay, you need this to be bigger than this for this to generally hold. So you have to believe that that your Ether is going to appreciate, or else you wouldn't do this. Okay, The other kind of interesting thing to note is that if we thought about coin A being a stable coin, so suppose you're borrowing in dollars, okay? Then like I said, that's the most quick and direct way to see that you wouldn't do this unless you thought the price of Ether was going to go up, the dollar price of Ether was going to go up. Another interesting thing that you see is that how much does it have to go up? Like what do you have to overcome? You have to overcome two things, not only the cost of borrowing, which is sort of captured in some of these parameters, but also the idea that when you do the borrowing technique, you only get 75% of the value in coin A. So you only earn 75% of the return. So if you sort of add and subtract the left side and the right side on these parameters, what you get is like this 0.25 R. And so what that's really saying is that there's this opportunity cost of borrowing, which is the foregone investment gains that you get on the fact that you only get 0.75 of the investment coin as opposed to 100%. So these price expectations, I'm just trying to argue, have to be pretty significant. They have to overcome not only the cost of borrowing, the fact that the interest is probably bigger than you're going to get for the staking, but also the fact that you're giving up some potential investment rewards because of the fact that you only get to invest 75% instead of 100%. That's an insight that I think is important. Okay, I'm not going to have time to go too much through another example, but an interesting example that we go through in the paper is thinking about what happens if coin A that you're borrowing is perfectly correlated or highly correlated with coin E. And the insight there is if that's true, so if there is no possibility of price appreciation or depreciation of the coin you're borrowing relative to your collateral, then all that matters are the lending and borrowing terms. And it's very unlikely that those would ever be positive, because I didn't mention it, but these rates, these deposit rates and these interest rates, these are endogenous. These depend on the flows. If it was highly beneficial just to borrow for borrowing's sake, then there'd be inflows into the protocols that would cause those gains to disappear. So that kind of argument tells you that, again, you absolutely have to have positive price expectations to be willing to borrow in these protocols. So that's that point. 2 seconds on this. This is also it's an interesting illustration that just generally looks at the fact that if you have some gamma distribution that's sort of saying what your expectations are on future prices, so then if we make that gamma higher than you're more optimistic, then we can sort of relate how your level of optimism to the return on investment that you require. And it's interesting, but this is upward sloping. Okay, so that almost seems a little counterintuitive at first. Why do you need, if you're more optimistic, why do you need a higher R? Or vice versa, if you have a higher R, why do you need to be more optimistic? Well, it's for the reason I just said, because if you actually go the borrowing route, you only get to invest 75%. So the higher the R is, the higher the return is on the potential investment you get from the coin you're borrowing, the more optimistic you have to be about the future price appreciation of your collateral. Okay, so we do it. So what does this all mean? When you get to the regression model, it basically feeds into this idea that we want to relate belief that prices are going to rise, which can be measured both by sort of the idea of the existing price level, how high it is, and this crypto fear and greed index. And when we estimate this, lo and behold, we find what you would expect, the idea that higher prices. And this, by the way, why do we use the price level? This sort of just relates to the idea that's in Liu and Davinsky's 2021 RFS paper, this idea of sort of momentum trading. When prices are higher, people believe prices are going to continue to rise. And then, like I said, we have the crypto fear and greed index, so the majority of the explanatory power is coming from the Ether price. So just supporting that hypothesis. Yep, I'm almost done. As I said, just a quick idea about what's going on with, I'll just do the highlights. If we just look at the titles. So retail investors are driven by interest rates in the real economy, no large effect for real investors. So if you add those two effects, you see that the real effects kind of go away for the large investors. Likewise, if we move to, we can see that the large investors are driven by the deposit APR. So again, the large investors are really driven by the value that they get within the protocol. And again, the way to interpret that is that the way I interpret that is their money is locked in the crypto world. So their movements are not so much based by what's going on in the real, what rates they can get in the real economy, because they probably can't even easily get this money out of the crypto world. It's more chasing yield within the crypto world. Okay, I think I'll just summarize there. So search for yield, motivations drive depositing. This effect is particularly strong for retail users. And has been reinforced by the low for long interest rate environment. That's getting at this sort of dynamic ideas. And large investors are guided primarily by interest rates offered in the DeFi protocol. And then when it comes to borrowing, expected motives are crucial. There is some extent to which large investors are driven by governance benefits. But I will say that one thing I didn't quite cover is that if you think about borrowing an alternative coin, and A gets the governance benefits, so that's going to be a negative effect on your decision to borrow. Because again, if you just sold the coin and borrowed, you get 100% of that value in the alternative coin. So you get more governance benefits. So for the sign to be positive, it's probably going to be driven by something more like purely speculative behavior, or a leverage trade. So if you've got Ether and you just want to leverage up your Ether, okay, because you think the price of Ether is going to go up, well then if Ether is paying any types of governance benefits, then you can get even more governance benefits. So that's the idea of how that can be positive. Okay, I'll stop there. Thank you.
Great, thank you. Yeah, so the discussion is by KT1 from LSE.
It's automatic? No, there's a.
Yes.
All right. Well, I want to thank the organizer for inviting me here. Like Eric, this is my first time here in Torino, and I cannot believe I didn't make it here earlier. It's a beautiful city, and with a snow-capped mountain, and there's a jazz festival going on right now. For those who didn't know, I just saw the banner when I was in the taxi this morning. And to discuss the topic and the paper, I'm very interested in. Part of the reason is I lost quite a bit of money in Avi. So I'm fascinated with this new form of financial intermediation. I'm very glad to see Rod working on this topic. Let me just do a quick summary of the paper. So and Rod and his co-authors go down to the transaction level and to analyze the rationales for DeFi borrowing and lending, and they find the deposit are negatively correlated with policy rates for all investors, large or small, but for longer maturity government bond yield, they find the deposits are negatively correlated. So there's still this searching for you for small investors for longer maturity interest rate, but not for large investors. And deposit of large investors tend to respond to the interest rate offered in RV, but not for small investors. And the borrowing side, that's the lending side. The borrowing side is related to the market sentiment and expectation, and this probably will drive the speculative motive. And for the large investors, also the governance. So very quick summary of the paper. And if you look into the data, and they actually discovered this as well, the deposits here listed very large tokens, ETH and USDC and wrapped Bitcoin and DAI, Link and USDT, dominated by large tokens and stable coins, and the borrowings are even more dominated by stable coins and some borrowing in ETH and Bitcoin. So I just want to give a general background on that theory. So I'm glad Rod present the theory part of his paper. So I will not spend more time on that. I just want to discuss in general how to understand the theory behind this this particular financial intermediation. We all know borrowing and lending. They happen because there's a gain from trade. So in my paper with Jonathan, we say there's gain from trade, but we abstract away from that. We say there's a Z. What is a Z is? We don't say. I view this paper deep into what that Z is. So that's what I saw this, it's one step forward, looking into what is gain from trade. Do they actually any value offered by this particular protocol and this type of innovation? Okay, so now I'm just let's see what one motivation highlighted in the paper this gain from trade. Borrowers for a good or bad reason and believe they can get a return and from the borrowed token that's higher than the lending interest rate. Okay, and willing to leverage. So so this return could be due to speculative reason, or there's some sort of private return, which is private benefit of governance right. So that's one way to capture the Z. Either you believe that your underlying collateral will rise in value, therefore you want to borrow against it and invest on the collateral again. This is what we know, all know, the leverage stack type of strategy, which I also used and failed. You never leverage on a highly volatile asset. This is what I normally teach my students: risk management. Rational risk managers will not invest in engage high leverage when underlying assets is highly volatile. But I did it. Guess what? So anyway, but a lot of speculators are engaging this leverage stack strategy to engage in speculation in the DeFi space. It's actually quite for when market's going up, it's great returns. Or for private, not measurable, or observable returns. Okay, so I think these are all sensible. I want to push also a little bit, just based on the observation, most borrowings are in stable coins. So if there are private benefits from having this governance right, maybe we want to dip into this claim a little bit further. Is it are there actually I don't know the ownership structure of these stable coins. Are there benefit of owning the governance right of these stable coins? So that's question mark, because I don't know how USDC, USDT, how they give out their governance right. I think it's a very interesting point. I know for other type of coins, there are lots of issues to be discussed, whether you want to increase the fee, US or say the Uniswap, and type of liquidity provision structure. I don't know about stable coins, so I want to see whether their contention in running these stable coins. Is the leverage the main driver instead, even for large investors? So just a little bit deeper in that. Only 1 minute. I have a lot more to talk about. So okay, I'll be fast. So Rob lists 3 unique characteristics of DeFi learning. I want to add one more. Because just want to say these are interoperable. All these protocols, they're all on chain. So therefore, one thing we find is the arbitrage capital move much faster on chain than the real world. You see a lot of arbitrages going on. While Rob was presenting, so this thought came to me. So I just want to quickly mention this. So when you borrow, you're really shorting it. I said you're borrowing stablecoin, you're shorting it. You are not betting it. Definitely, it's not good for one. Let's say you're borrowing, is the price going to go up? Stablecoin in general, price will not go up very high. So there's a reason for many borrowings are done in stablecoin, especially compared to your Z. In your case, speculative beliefs or private benefit. So this maybe should be highlighted a little bit more. And the second reason for borrowing is actually not when your underlying is actually price is going to go up. Is you think your underlying collateral price is going to fall because you're going to default. You're going to borrow a huge amount of stable coins when the collateral is overvalued. So that's also occasionally could be the rationale too, but very rare, but it could be. So I want that to be discussed. So anyway, so just quickly, empirical discussion. Can we actually look a little bit deeper whether leverage is the main driver? Could we collect more evidence that what borrower do with the stable coins? Also for the governance, can we actually do 1 or 2 event studies to show? Well, these are very regression-based type of suggestions. So I have many. So we can go over this. These are they're minor. So also regressions on the borrowing regression and deposit regression. Very interesting finding. I learned a lot. I think be great we know what the Z is. So this is actually quite informative study. That's it.
Thank you. Yeah, you want to respond quickly?
Yeah, so thanks so much for the comments. When I mentioned the Geo paper, I should have mentioned the capital course one of the bottoms of that paper, so I apologize for that.
But yeah, no, just so certainly the leverage trade matters, and we're not precluding that at all. It's just that I thought that the leverage argument is obvious, that you would never try to leverage up unless you really thought the price of Ether, for example, was going to go up. In other words, it makes no sense to do that. So the model was really trying to explain why you would also borrow, say, other coins. You say like some arbitrary coin A that And also stablecoins don't typically have governance benefits. So the coin you're borrowing, it might be more likely one to have a governance benefit. So that's why we're trying to work through both the leveraging model and the idea of borrowing another coin. You also, of course, care about the price of its coin relative to Ether. And in fact, this is the issue, that even if you're borrowing a stable coin, which is priced in dollars, your obligations are in Ether. And so you always care about the relative price of dollars in Ether. So you're always subject to the health ratio either way. But I guess I'll leave it at that. But thank you so much for the comments. And I look forward to hearing about the empirical suggestions.
Great. Okay, there are a lot of questions, I think. Okay, since you're
Okay.
Let's try to keep it short.
Yes. Okay. So two simple remarks. So one is if one of the motivation behind borrowing could be safe to haven, because most of the times cryptocurrencies are mostly related to the idea of a safe haven in period of uncertainty. So in the econometrics, probably you can elaborate this issue maybe, or including a measure of uncertainty, or maybe, I mean, also including the price of gold, because the price of gold is an important control for this event. And I have also one remark on econometrics. So you are estimating in levels, variables. I think the short period of times and the variables that you used exhibit a lot of persistence in this period. So it means that you may have a problem of spurious correlations. I think you can also run these regressions in first differences, especially is an important control, especially for robustness checks for your results on governance, for example. So you can elaborate more on this.
There was
Thank you. So I have a question regarding the reusage of tokens. So, for example, whether you thought about alternatives that would explain perhaps those expectations. So what I mean actually is that have you thought about plugging in their liquid staking, meaning you can stake your tokens, get some earnings, and then put them into Aave, and then whether it has also some kind of impact on the price expectations. But this kind of reusage can also might prospectively play some role in this equation. Thank you.
But you can also obviously stand in the front and
is he going to comment? Or
no, I mean for that I don't think so.
Okay, I just have two small very questions. So first, I agree that the tokens that are traded on Aave are not governance tokens, right? Because you would need different kind of smart contract, or you would need the governance tokens indeed, and it's not the token that you use for the application, for example, or DAI, for example, which was traded, which is a product of the MakerDAO, but it's not the governance token that you use in order to vote. And then second, I was wondering about this voting dates that you have, because usually it's a voting period, right? So you would have maybe 3 proposals, you can vote within a week, and then all 3 proposals would be in 1 week. So I was wondering how you actually would tackle this kind of problem. Yeah, thank you.
So following up on Kathy's comments, I think you can just look what people are doing with the money with the tokens they are borrowing. And so it's all on the chain, and maybe at least look if they send it to a DEX or if they send it to another protocol, and to which protocols do they go. And you could potentially identify the top 5 protocols where these tokens go to see what people are doing with them.
Really quick.
So the analysis stops in 2022. So far, the Fed fund rate went from 1.5 to 0 and up to 1, but it went from there to 5.3 in 2024. It would be good to expand it, because that would make a big impact. the liquidity analysis that's done, not liquidity, scratch that, the leverage makes complete sense per se, but it's simply saying that if you have a futures mechanism where you take initial margin, where the volatility of that margin is zero, because it's, say, US dollars, here you have some volatility, and you can liquidate not once a day, but continuously. So what's important in analysis is the holding period of the lending or borrowing, which then connects to the fact that is there any governance? And since there is no holding period per se, it's a bit of a,
Yeah. Okay. So I don't know how many of these questions I can answer, but I'll take them all on board. Let me just start maybe with the holding period question. So that's a very good one. So we looked at a simplified model where 1 period, and we just assumed that you could only liquidate. It gives you a very tractable way to think about the investment decision if you know that there's going to be an end date. Whereas if we, as you said, if you think about the investment in a continuous sense, then you really have to think about events where you're ever going to be in the red or in the black, or liquidated, and that would be much more complicated. So the comment's well taken, but we don't do that. Gee, I'm trying to think about what other things to address. Let me talk to you more about the governance token idea. We're trying to capture this idea. We recognize that it generally doesn't apply to stable coins. We believe it applies to some other coins, and then I identified the periods for which the voting rights were active. But yeah, let me talk to you more about that. There's so many moving parts here. It's difficult to get all this right, but I'm very receptive to trying to understand ways that we can improve this. And then gold might be a reasonable thing to include. Generally, I mean, but in terms of like a few of the other questions, I mean, always the issue here is like, moving into a safe haven, like always the issue here is, should you borrow or not, right? You could just sell, if you have Ether and you're worried that it's going to be volatile, you could just sell it. So the real question that we're trying to answer, because we're trying to understand activity in lending pools, is when would you not sell it? When would you instead hold on to it and borrow, right? Which means that you're still subject to the risk of its price fluctuations. So I think I'll just leave it there. But again, thanks for lots of great comments, and we'll try to address them all. Thank you.
Great. So the next presentation is by Alfred, and it's about systematic fragility in decentralized markets.
Okay, thanks so much for having me here. It's a great pleasure to be here. And this is joint work with Christine Pallour from UC Berkeley. So we want to look a little bit at systemic risk and contagion. And this has been looked a lot in traditional financial markets, in banking systems, and spillover risks there. But there's very little work in DeFi markets on this. And why is this interesting? Because we have free moving capital. There's no rules. We can have innovation in these markets. Especially, we can overcome capital constraints with flash loans. So anybody can borrow almost infinite amounts for very short periods of time, which you don't have in traditional financial markets. All the information is on chain, so we can really see a lot of things that we cannot see in TradFi. And there's also no regulators, no circuit breakers, nothing that's kind of, nobody's stepping in. There's no lender of last resort, no bailouts. There's no rules, anything goes. And it's kind of interesting to see what happens in such a world compared to a world where we do have bank regulators. So we are looking at the lending market, which is quite big. So I looked yesterday, it's $32 billion at the moment, according to DeFi Llama, and Aave is one of the big players with 10 billion. And we also look at data from Compound, which in our sample period was bigger relative market size. So I hope to convince you that we have some new interesting evidence on fragility in these lending platforms. Specifically, we can look at these negative feedback loops. So whenever loans get liquidated, the collateral very often gets sold immediately on a decentralized exchange. That means that the value of the collateral goes down. That means more loans are under collateralized. That means more loans get liquidated, more collateral gets sold, and the price goes down further. And we are in this kind of feedback loop where there is a lot of loan liquidations. So let me talk a little bit about how DeFi lending works. So we already heard that from Rod. So say you have Aave here, a lending platform, and there's some borrower who puts up some collateral, say 11 wrapped ETH, and borrows 1 Bitcoin against this collateral. And this is fine as long as the value of the collateral exceeds the value of the loan. And we have to have over collateralization. So say, for example, you have to provide 1.2 times the collateral relative to the debt assets. So in many ways, this is similar to the repo market, similar to margin trading, but in some ways, it's also very different, specifically in the case that something goes wrong. So what happens if you're under collateralized? So in the repo market, or if you borrow on your margin account, your broker would call you and say, Alfred, you have a problem, send us some more money. In DeFi, nobody calls you, you're on your own, and the broker doesn't even care. So the platform, Aave, doesn't care. So they don't liquidate you. You're out in the wild. Anybody on the internet can liquidate you. And there's bots watching which loans are under collateralized, and they go and immediately jump on these opportunities. So how does it liquidation potentially work out? You have a liquidator who finds that your loan is under collateralized. The liquidator repays the loan, repays the Bitcoin to Aave, and in turn gets pretty much your collateral of 11 ETH. So what if that liquidator doesn't have any money? The liquidator can go to a flash loan provider and borrow the Bitcoin from the flash loan provider and use that to repay the loan. So then the liquidator takes your collateral, swaps it immediately on a decentralized exchange like Uniswap for the Bitcoin that the liquidator needs to repay the flash loan provider. So without any capital, a liquidation bot can liquidate your loan. And if this is done correctly, then the liquidator gets some kind of profit from this whole liquidation. So in many ways, it's kind of irrational that we see liquidations in the first place, because whenever you are as a borrower and you see that you are under collateralized, it would be best to liquidate yourself because then you can pocket the profit. So in a perfect world where everybody acts rational, we would never see any loan liquidations out there. But in fact, we do see a lot, which is kind of interesting, that people cannot be online all the time. They don't watch what's going on the blockchain 24/7. You need to sleep, and so loans do get liquidated. So we show this has some implications on prices. So if the liquidator sells this collateral on a DEX, we show that if this has some kind of permanent price impact, then all these oracles that look at the DEXs to find prices, price information, update and say, oh, now the price of that collateral is less. More loans are under collateralized, and you end up with these liquidation waves that form where a lot of loans get liquidated at the same time. So we have look at Aave and Compound. So we look at sample period from 2018 to 2022. We have about 42,000 liquidations, 37 collateral, 41 debt tokens, and about $2 billion worth of liquidations in our sample. So not all the liquidations are big. So the average is kind of low at 64,000. The median is only $3,500, but there's some large ones in there. So the largest loan liquidations was $50 million in our sample. So we also collect data on on these decentralized exchanges. So we look at Uniswap, SushiSwap, and 6 other clones out there that do pretty much the same thing, but are less well known. So the biggest, that's similar to what Rod had. So the biggest, if you look at the big token pairs, it's very often wrapped ETH or Bitcoin against some stable coin. And that's kind of consistent with this leverage story that people take leverage in DeFi. I don't need to really show this here in this audience, but because of the bonding curve in DeFi, we can really figure out what is the price impact exactly when you sell your tokens, your collateral on Uniswap. We can exactly compute what the price impact of each trade was. And therefore, we can really compute exactly if the liquidator then goes and sells the collateral on decentralized exchange, how much does this liquidator move the price? And we can compare that, we can exactly figure out the contribution of the liquidator to the return of the collateral token. So here is a picture that pretty much summarizes what we want to do in the paper. So this is a liquidation wave of 180 liquidations on the Link token that happened in 2021. And what you can see here in gray is the loans that get liquidated. And you see it starts with a little bit, then there's one jump in the liquidation wave here, and a few loans get liquidated, and you see the price dropping, and then the price drops further, and you see this whoosh, huge wave of loan liquidations that come along. We also see that the price goes down in that liquidation wave. So a lot of the loans in this liquidation wave are liquidated on SushiSwap, which is the blue line. But we see that this impacts a lot of other DEXs as well. So Uniswap is the orange line. So we see that the price there drops too. And most interestingly, the price on Binance, which is green, drops as well as a consequence of this liquidation wave. So none of the collateral was liquidated on Binance, obviously, because it's not possible to do this in an atomic transaction. You would have to move the collateral to Binance, but we do see that there is impact on Binance as well. So this raises two interesting points. First of all, price discovery can happen on the blockchain too. A lot of people think all the price discovery happens on Binance and Uniswap is just tagging along. So here price discovery really comes from the liquidation on chain, and that Binance follows that. And second, it can also, we see that the blockchain is of course not an isolated system. We do see these spillovers between blockchain markets and off-chain markets, and that might be interesting for regulators if, for example, we trade stocks on the blockchain or more stable coins in different currencies on the blockchain, whether this has real implications on TradFi markets in these spillovers. The last thing you can take away from this picture is the red line, and that is the price impact that would have happened from all the liquidators when they sell their collateral. So we can see that a lot of the drop in the price initially was really due to these liquidators selling the collateral on the DEX, and we can really attribute a lot of that price drop to these liquidators. The price would have dropped much more, but then somebody else was buying the token, so the price didn't drop as far. But if there was nobody stepping in, the price would have dropped all the way down according to the red line. So the first finding, which kind of surprised us, is that a little bit was that there is permanent price impact from these loan liquidations. We would have thought this is a noise trade. Bob's loan just happens to be at this threshold and gets liquidated. What does Bob's loan tell us about the world? Nothing. But here it's surprising that there is this permanent price impact. So this is one liquidation of 20 million Bitcoin worth of Bitcoin, and you can see how this gets liquidated on SushiSwap, which is the orange line. So you see a huge drop on SushiSwap, And then arbitrageurs come in and say, hey, the price on sushi swap is very different from Uniswap. Let's close that gap. And you can see that it converges, but it converges at a price that is much lower than the price where it was before. So there's some kind of permanent price impact. And we look at this in a more general setting and say, what is the contribution that the return of the liquidating swap has on the 5-block return. And we do find that these liquidating swaps explain a good chunk of the return that's happening in the market around these loan liquidations. And this is not only on the exchange where the loan was actually liquidated. This also, we see this happening within 5 blocks on the DEXs where the loan was not liquidated, but they just follow through. So these liquidating swaps do have an impact, not only on the DEX where it was actually liquidated, but also on the other exchanges. So here's a little picture about how these loan liquidations work out, these loan liquidation waves work out. So we cut out the liquidation wave itself. We collapse that to 0. And then on the left-hand side with the negative numbers, you see what happened before the liquidation wave. And then on the right-hand side after 0, you see what happened after the liquidation wave. And we do see that there is some kind of permanent price impact that happens through these loan liquidations. The price stays lower afterwards after this liquidation wave. So when we look at the returns throughout the whole wave, not just around 5 blocks, but if we look throughout the whole liquidation wave, what's happening, we do see again that these liquidating swaps have a bigger explanation of the return, of the long-term return throughout the whole liquidation wave if there was multiple loan liquidations. If there was just a single liquidation, as you see in columns 3 and 4, then these liquidating swaps don't really matter. So this was really just Bob's loan that was liquidated, has no broader impact on the market. But in these liquidation waves, you do see that there is a longer lasting price impact that really comes from these swaps that liquidate the collateral of the loan. So these liquidation waves also create some kind of risk in markets. So often in finance, we think about fat tails in the market. So here we have short-term token returns. If there were no liquidations in blue, and if there was a liquidation in orange, and if we can see that these liquidations really contribute to these extreme token returns. So in some sense, this is interesting because liquidations are not only bad for the person who gets liquidated. I'm sorry, Kathy, here. The liquidations are also bad for everybody else who now has a much more risk in the market that there is these fat tails. Even if you're just an ordinary token holders, these liquidations cause some negative externalities for you in the market. So the last thing we look at is these liquidators. So we observe about 1,000 different liquidators for these loans. So today, or at least we observe 1,000 different wallet addresses. It could be that one liquidator controls several wallet addresses, but we cannot really tell that. But so this might be an upper bound of the number of liquidators. Yet even with our fairly coarse measure, we see that liquidation is very concentrated. So the top 20 liquidators do about half of the liquidations and liquidate about 3/4 of all the collateral. So it's a very specialized industry. So the top liquidator in our sample liquidated over $400 million in our loan period. So there's some skill to this. It's not that anybody can go out there and be a liquidator. This is a very specialized business. You have to be very fast. You have to know how to get your transaction at the top of the block. You have to pay the right amount to the validators to jump the line, to be the first one to liquidate the loan. You have to perhaps even analyze the mempool to see where the price is going. So this is an interesting high-speed business. We do see that a lot of liquidators also specialize in one platform. So we see that some addresses focus only on Aave or on Compound. There's some liquidators that do both, but not that many. So the next question we want to look at is when are swaps being used? So I showed you initially the full example with the flash loan and the swap on the DEX, but you don't need to swap. You don't need a flash loan. If you have enough money, you don't need a flash loan, and you don't need to sell the collateral on the DEX. You can also keep the collateral in your wallet if you want to. So there's not really a need to sell it. So we look at what drives the use of these liquidating swaps. And one thing is obviously collateral size. So if this is a huge loan, then you want to swap it because you don't want to have that inventory risk. If I evaluate a loan for $200, then I might say, well, it costs me extra gas to swap the loan. I might just take that collateral in inventory and not swap it immediately. We also see that liquidations are more common in large waves and short waves, but it's not totally obvious what the causality is here. It could be that the wave is big and short because people use swaps and drive down the collateral price and trigger this kind of feedback cycle to liquidate the loans. Or it could be that in these short, big waves, people want to quickly get rid of the collateral and therefore use swaps. So we cannot really say what the causality is. Two stories are possible, but at least there's a correlation that we do see more swaps being used in these large and very quick liquidation waves. So the last thing we want to look at for a while, but never came around to, but at least I can show you anecdotal evidence, is that there is perhaps predatory liquidations. So you can think about these liquidators not just waiting passively for Bob's loan to drop. If we see that Bob's loan is close to the edge of a cliff, then I just push Bob's loan a little bit so that it falls over the cliff. So I can just manipulate the price a little bit so that Bob's loan is underwater, and then I can make some money from liquidating the loan. So of course, in DeFi, it's the Wild West, so why would you not do that, right? And so we look at one case study here. There were 147 loans with Bitcoin as collateral being liquidated. It was a liquidation wave that was about $64 million. And we trace what did the liquidators do before the liquidation wave happened. And so the liquidation wave starts here at time 0. And again, you can see in gray the amounts of loans that were being liquidated. The orange line is the price of the collateral. And we can see here in blue the position that the liquidators have during this time period. And what you can see is that before the whole thing starts, the liquidators short the collateral. So they go negative in the collateral. We see that the price drops. Then this loan liquidation wave starts. The price really comes down. So these liquidators keep a pretty flat position until the price bottoms, and then the liquidators start buying. So it's not, these liquidators are not just innocent bots that stand there and try to save DeFi platforms from being having to deal with bad loans. They are sometimes actively pushing people into liquidation, and therefore our evidence, anecdotal evidence at least, is consistent with this story, that these liquidation spots are far more active and pursue potentially complex strategies to take advantage of these loan liquidation waves. So to conclude, I hope to convince you that there is some interesting fragility in these DeFi lending markets, that we do have some evidence of these feedback loops that happen where the sale of the collateral drives down the price. A concern that many regulators have in TradFi markets, and that often justifies intervention in financial markets. We do have some transmission of risks from lenders to token investors through these fat tails that come in these markets. And as with CBDC and more smart contract-based systems, such arrangements for DeFi lending and margin trading will just become more important. And the question is, what implication does that have on risk in markets and potentially on systemic risk? And we hope to shed some light on that. Thank you very much.
Great. Yes. It's your turn.
So, right. Okay, let me see which way it is going. I'm also confused. Okay, perfect. Yeah. Thank you for having me here. It's a great conference, and my name is Wenqian Huang, so I'm from the BIS. Yeah, before getting to the substance, usual disclaimer applies. The views are all mine and not necessarily the BIS. Yeah, I enjoy very much reading Alfred's paper as usual. So this one is really, yeah, speak to my heart, and I think Alfred did a great job in the paper and also in the presentation in giving you the gist of the paper. So I won't repeat that too much. Instead, today my job, I guess, is to provide you a bit more context about the DeFi lending. So yeah, coming from the BIS, let me present you, sort of the traditional or DeFi in traditional eyes, right? So balance sheet. So basically, when I think about DeFi, I think about them as repos and securities lendings, right? So when the user borrowed stable coins and pledged these volatile coins, such as the ETH, as collateral, then you can think of them as a repo transaction, essentially, right? So, and I think Rod also presented something similar along the line that, in this case, the user actually, has this long exposure to the deposit. Doesn't work anymore, and okay, so, but yeah, but basically on the balance sheet, on the asset side, you have volatile coins, and then on the liability side, you have the stable coin, right? So and you can use this kind of mechanism to level up your exposure to the volatile coins. Essentially, yeah, when the user doing this direction, you can think of them as a long position of the volatile coins of ETH, right? When the user do the opposite direction, then essentially, they are depositing stable coin. So basically on the asset side, they hold the collateral of stable coin, but they are borrowing volatile coins, right? So in this case, you can think of them as securities lending, right? So it means that the users can sell this, can short sell these borrowed volatile coins with the stable coin collateral, right? So basically, these are sort of the traditional eye of traditional view of DeFi lending, right? And what is important, I think, also highlighted by Rod's presentation, is about this over collateralization, right? So you have this loan to value ratio, where the coins that you pledge as collateral would subject to some haircut. For instance, like for USDC, the haircut is 20%. At March 2023, I think. And this 20% haircut means that you can only leverage up to 5 times permitted by the lending platforms, right? And actually, this would be sort of the leverage concept corresponding to the traditional or the classic literature by Giannakopoulos and Fausto, right? So this is the leverage requirement. But actually, you can also see the investors do not necessarily follow all these leverage requirements, right? So the actual leverage by investor can be measured by simply the asset to equity ratio based on the wallet portfolio, right? So that is the leverage concept correspond to Adrian and Shi, 2010, right? So I'm giving you this context because I want to give you like why liquidations is an important thing in the DeFi lending. So when we look at the data in a recent paper, what we find is that the actual leverage, which is the blue line here, ranges from 1.4 to 1.9. Right, so it means that as an investor, when you think of their asset to equity ratio, typically their asset is like 1.5 times of their equity. This is similar to hedge fund leverage after the GFC, right? So that has been documented recently and also by an FSB report. But when you look at the LTV implied leverage, so this is the haircut people or these lending platforms would take from the borrowers. Then the LTV implied leverage, which is the dotted line, it ranges from 3.5 to 4.8, right? So the actual leverage is far below the allowed leverage by the LTV ratio, right? So why people do not lever up to the maximum as what you would expect in a traditional finance? Well, their fear. Well, one of the hypotheses in the in the paper we found is the fear of auto liquidations, right? As Alfred just mentioned, rational traders or rational borrowers would not allow liquidation to happen by others because they would be rather better off in self-liquidating their positions. However, what you see in the paper from Alfred is that still there are large amount of liquidation volumes, right? But here, when we look at the lending resilience through the eyes of liquidation, there are two things, right? One is the actual liquidation. That is sort of, that is captured by the yellow line at the bottom panel. You see these huge spikes. I think that reflects the liquidation waves that in Alfred's paper, that has shown in Alfred's paper. But when you look at the portfolios that are close to be liquidated, that is the upper panel, right? So that is the dotted line where we call it the pool at risk. Basically, those are the portfolio positions, the borrow positions that are very close to be liquidated but not liquidated, right? So this actually sort of corroborate with Alfred's statement about rational traders. They would not allow liquidation to happen. So you see that for the pool at risk, it actually co-move very well with the borrower's leverage, right? So when you have higher borrower leverage, you do see a larger proportion of the pool that will be close to be liquidated. However, people are very carefully keeping their positions not to be liquidated to some extent. But when events happen, especially after 2022, when you see there are several events starting from the Terra Luna fiasco, and then to the Celsius, and then to FTX, and then to some Aave attack, and most recently to the Silicon Valley Bank and the USDC DPAC, right? You see these liquidations, they are mostly driven by event, right? So it's not really like people are letting their portfolio to be liquidated. It's more that there's some shocks. And then when the shock hits, people are not prepared, and that's why they have liquidations. So given this, I think in this context, you can really see the contribution of Alfred's paper, right? So it highlights the importance of understanding these liquidations, because it really reflects something sort of like the stress scenarios in DeFi lending, right? And it's very important to note this, not only the price impact, but most importantly, this negative feedback loop between price drops and liquidations, right? So this is really a fantastic paper to highlight that, lending platforms, they might be micro-prudential in the BIS term, but they are not macro-prudential in the sense that they safeguard themselves while transmitting the risk to the other players in the system, because the or the auto liquidation might have self-reinforcing impact on the prices, which can trigger another round of liquidations, right? And finally, I also find that the predatory liquidation is very interesting. You know, it shows you that how strategic behaviors can sometimes also push the distressed borrowers over the edge. So my main comments would be on some sort of suggestions on formalize or to perform some systematic analysis, because I think you see a lot of interesting events happening in this space, but there are always this thinking about confounding factors, right? So one thing is about the permanent price impact. I think it's very nice that Alfred showed you, the liquidation waves coincide with permanent price impact. However, like economically, I cannot really rationalize that because, because a lot of these liquidations, as we see, they are driven by events, but not by change in the leverage requirement, right? So if it's really like the deleveraging story by Giannakopoulos and Frosto, then you would need to observe deleveraging, forced deleveraging by the platforms. But I don't think that is the case, at least not in the data sample. So I would suggest to do a systemic regressions, a panel regression basically, where you just put a simple, dummy variable indicating whether there's a liquidation or not for that particular token and on particular dates, basically, where you control other variables that may affect the collateral returns, right? So this would give you a more more statistical power in terms of whether it's the confounding factors or it's just collateral returns. And most importantly, on delineating the feedback loop, basically there are two legs, right? So first is that price started drops, and then you have the liquidation, you have the LTV ratio rise above the liquidation thresholds, right? And then the second leg is that the keepers come in and sell the collateral and price drop further. And these two legs, they reinforce each other, right? And in this kind of setup, I think a VAR-X test would be useful, right? So basically you collect the endogenous variable, including the collateral return, some kind of volume or imbalance measures, and also volatility measures. And then on the exogenous variable, you put in a series of dummy variables before the liquidation happened, at the liquidation, and after the liquidation happens. And then the impulse response function to these liquidation shocks would capture solely the second leg while controlling the first leg, right? So I think that should be feasible with your data set, and it would also give you a cleaner result on what is really the impact of liquidation on the collateral returns. And finally, I find flash loans are really fascinating. This is something unique to DeFi, right? So they have zero duration, zero credit risk. However, I would argue that arbitrage capital, even in the DeFi world, is not costless nor unlimited, because the fresh loans do involve interest, right? So it's not like, the fresh loan pool is always there with zero fees, right? So there are always these fees. And I think that explains part of the results about, the usage of the swaps depends on the size of the liquidations, right? So I think the economics behind could be just that, it depends on the profitability of liquidating a loan, right? So if a small loan, so actually in a DeFi lending, we do observe bad loans. So those loans that were not liquidated. And the reason is that they are too small to justify the gas fee to liquidate those loans, right? So it makes sense that the usage of the fresh loan should depend on the size of the liquidation and the profitability of liquidations. So I would suggest some modification on the regressions in table 5, where you can also include, controlling the cost of using these flash loans. So I have some other minor comments where we can take it offline. But finally, yes, I just want to congratulate the authors on this nice paper. Very good topic, timely and fascinating. It again highlights that sometimes you might have microprudential rules, but it would have macro impact in terms of the unexpected consequence. So I would recommend everybody to read this paper. Thank you very much.
Okay, thank you so much for this very nice and insightful discussion. This is great. All the comments are well taken. I just want to say one thing, that the cost of flash loans varies quite a bit from platform to platform. So on DYDX, you can get the flash loan for 10 to the minus 15 ETH, I think. And on Uniswap, you pay 30 pips. It depends a lot which platform you're looking at. And so we didn't really include that so far, but certainly something to look for.
Awesome. Maybe we have time for 1 or 2 questions max. So you already asked a few. So let's go with that.
Oh, very short. Okay, I just want to mention the just follow on James' comment on permanent price impact. And typically, fire sale should have transitory price impact. And one of the reasons we're hoping was as a motivation of there could be asymmetric information. Therefore, there's a permanent price impact. And this is the event that review that information. Typically, in the conventional finance literature, fire sale has a permanent impact, either due to information friction or due to the fact that segment market. Even that, there's some sort of recovery will be slightly longer. There eventually will be a recovery, like in the housing market. But just
yeah, that certainly could be one very good point. That there is something fundamental we learn about the token, and that triggers then this loan liquidation wave. That could certainly be part of the story. Yeah.
Very quickly, following up on the same, I think, question, and why not also raise it? So, how permanent is permanent? I think your chart showed like 15 minutes.
Yeah, good question. So, relatively much longer than we would have expected, right? So we would have expected, we didn't want to look at too long of a time horizon because a lot of other things happen in the long term. But given that this is just there's all these arbitrage bots everywhere, right? And you would think that some of these loan liquidation waves are not too big. And why does this even last 15 minutes, right? So this one liquidation wave of Bitcoin that I showed you, that was totally surprising. We haven't learned anything about Bitcoin here, but we do see that there is a longer lasting price impact, which was kind of puzzling to us because we thought that was really an idiosyncratic event.
Great. So due to interest of time, since lunch is waiting upstairs, I would suggest the question should be taken during lunch. And yeah, it was a great second section. And I see you all again at 2 p.m. here, and lunch is served upstairs.
comments. Okay, the floor is yours, and thank you for being here.
Yeah, thank you very much. Let me just figure out how I can continue. Okay. Okay, perfect. Okay. Well, thank you for the organizers. Thanks, Lorenzo, for having me here. I'm very happy to present. Yeah, my topic today is about the economics of decentralized autonomous organizations. And I would like to add that just still work in progress. I just recently added a new data update, so any comment of yours is welcome. Okay, let me start with a small motivation for this topic. So as we heard maybe from today, and as we also know, that blockchain-based markets and DeFi are growing, becoming very powerful instruments, especially in finance. So there's been a massive growth since 2020. And just recently checked the numbers, it's over 100 billion of US dollars worth locked in this digital assets platform, at least of March 2024. But now the problem is that that these blockchain platforms depend on trust, and then they promise network effects. So we have the paper of Grglevitz, who says that well, if you design your tokens properly, then more people will come and adopt it. Maybe I can also stop. Yeah, no problem. So maybe let me repeat it again. So there are blockchain markets. They're becoming very powerful blockchain applications. The problem is that they depend on trust and the promise of these network effects. We have some papers arguing that it depends actually on the token design. So if you give incentives to the people, then more people would like to join these blockchain applications. And Kong argues, for example, that if you design the prices by managing the token supply, then more people are incentivized to go to these blockchain platforms. But still, there's high competition. There's still a lot of information asymmetry, and we don't really know how to trigger this kind of network effects or platform adoption that will increase the value. So I argue one possible solution for that is to establish a decentralized autonomous organization. This is a new democratic corporate governance for these blockchain applications. And the beauty is it allows the users of these blockchain applications to have a say in the direction of the venture, or decide on the management of these blockchain applications together by voting with these governance tokens that we have. And well, the benefit is that we actually align the interest not only of the manager and shareholder, but also of the user. So we have here combined roles. And you can think something of a founder or a CEO who owns a company, but then also uses the services of this company, for something like a banker. Well, ideally, this whole scenario triggers active participations and eventually network effects. And the question is, well, does it? Is it really the case that DAOs are going to helping and promote these platform adoptions? Maybe we should think a bit more about this, whether this exactly is the case. And well, this is what my paper is actually doing. I'm looking into this mechanics of DAOs. Well, the first question is, how exactly are they working? Well, what are DAOs actually doing? What are the people in these DAOs are doing? What are the underlying economics behind this? Maybe we should think a bit more about the incentives, the risks that are involved with these decentralized autonomous organizations. And finally, the question is, well, does this new governance system that we have actually adds value to the firms? And understanding these questions is, in my opinion, important because, first of all, it's a new market. We don't know anything about it, and it could have implications for new platform or new blockchain applications that will come. We don't know anything about this decentralized governance that exists. Is this something that could improve the company's workings? And then maybe you could also think as a new laboratory to see how it actually works with these combined roles of having a user, which is also a manager and also an investor at the same time. And since, well, similarly, structured companies are actually very rare and opaque. I believe that DAOs provide really excellent data in order to find out how this is all working. And now let me briefly guide you through my findings. So I hope I can explain you how DAOs work by providing this very simple picture. So within a DAOs, you have lots of members, and these members hold tokens. I hope I can show it here. So they're buying these tokens or maybe borrowing them. And then they're going to interact with either the off-chain governance platform or the on-chain governance platform, which will be some smart contracts. And in order to do so, they need to verify that they own the token on a specific point of time. And by interacting with these governance platforms, they are voting on proposals. Proposals are something about the management or change of parameters or anything that the people decide on the business direction of the venture. And well, once the proposal ends and all the votes on voting concludes, we just calculate the sum. And if this is according to some rules, and the proposal is accepted and eventually executed, and is going to change either the treasury accounts of the DAO. So, for example, there will be less or more funding, and then we're going to change the treasury accounts, or it goes to the DeFi application. So, for example, MakerDAO, which generates DAI for lending. And then there are going to be some parameter change, collateralization, or interest rate changes, or some other fees. So anything that we really would like to change. And this is how the governance process works. And well, now, what are the underlying economics of this, or incentives and risks? So in order to well, explain DAOs, I was trying to find examples in the traditional world. And I believe that DAOs resemble most equity partnerships, and I just read here the definition, where participants' actions jointly determine the production output and payoffs. It's exactly what is happening in a DAO. But by going through all these literature that we know on equity partnerships, we actually know that large partnerships are extremely fragile. This is because of the free riding problem, and they actually don't survive in the long term. So we have the paper by Kim, who is examining employee-owned companies, and they're saying, well, if we give shares to employees, there's not much that's going to happen. The share values not really go up because of the free riding problem. And then we have Ivashina and Lena, who are looking at real partnerships. You can think of consultancy firms, accounting, law firms, medicine, where you have partners. And this is, I think, one of the papers at all that have real data. And they see that actually, even in partnerships, you have this kind of centralization. You have junior partners, senior partners, you have named partners. So it's not really working that you have equal stakes at all times. It's converging to some centralized or concentrated ownership. But if this is really the case, and we know this already from the literature, so why exactly should we have then a new decentralized and democratic governance? Does not, I mean, what's the point if it's going to be centralized in the end? And then if it is also centralized, there will be potentially some agency conflicts between the large and the small token holders. There's again a paper by Grüglewitz and Leven who are looking at these difficulties when token owners have different risk profiles or different short-term, long-term horizons. Then this creates agency conflicts and well, adversely affects the firm. And in our case, in the DAO, it could mean that large owners become entrenched, or that minority owners are simply overruled. And then, well, the firm wouldn't work in the long term. So if this is really the case, should we then go actually back to decentralization and have equal stakes for everyone? But then we start with the free riding problem again. So by looking at this literature and comparing to the traditional companies, it does not really look well for the DAO. It looks like it will be like a short-term phenomenon. It does not really, or it should not really going to work. So let me just show you the data. So I used a sample of about 1,000 DAOs, And they're all extremely diverse because this is a really recent topic and they're just starting to evolve. And my sample has on average about 32,000 members. But then as again, because of this diversity, some few DAOs have even up to 1.5 million members. Then there are about 5,000 voters on average for DAOs, again, with a few having up to 1.1 million voters. There are about 100 proposals in total, and on average, 23% of all these DAO members are actually active in the sense that they're really participating in these votes. And in general, I see that there's a low disagreement between minority and large token holders, at least in the voting outcome. And then there's again a huge size disparity in the valuation. So there's about $53 million in assets that these DAOs are managing. Again, with a very few who are managing about about $4 billion. And they're also on average $107 million in market capitalization, again with a few up to $6.6 billion. And I also collected now new data on the revenue, and on average it's about 23K, again with very few dominating the market and generating about $2.9 million. And on the ownership structure, I see that on average DAOs start very centralized, but then over time they diverge to these decentralized or equal ownership stakes. So it goes more into this decentralized ownership structure over time. And now if I would like to compare a company or a blockchain company like Binance, for example, which is more traditionally structured, with another DeFi application, which is a DAO, then I see that on average, the DAOs surpasses actually this DeFi on other blockchain companies. And furthermore, if I only look at the DAOs, I see that the most high-performing one are the ones with an active community, the ones who are participating in votes, who manage the proposals, actually regardless of the ownership structure. So this means that this whole governance system actually works regardless the potential conflicts of agency or free riding problem. So what I'm trying to say is that the DAO governance actually is effective and working. So my paper is related to, we'll make it a bit faster, is related to partnerships, incentives, performance. Think of, as I said, consulting, accounting firms with up to 1,000 partners, but also hedge funds or venture capital. I also read a lot about and relate a lot the DAOs to the concept of ownership as a form of corporate governance. Everything from agency costs or minority owners or similar examples like we have in traditional finance, where the manager is also the main shareholder of the firm, for example, with families, CEOs, directors, employee ownership, shareholder activist ownership, and different types of owners with interest and influences, for example. And then it also contributes to the literature on blockchain economics with few papers writing also on DAOs and specifically on case studies. And I think Bakos and Halabuda is one of the few papers that also considers what I said, the ownership structure, but in a theoretical way. So whether it should be centralized or decentralized for DAOs in the long term. Okay, my data starts with a hand-collected data set from DeepDAO. I added more information from Snapshot, which provides all the information on voting and proposals, on these kind of information, and then also DeFi Llama, which gives more information on the financial side, on the assets of this application. And then I also used different blockchains to gather all the information. And I think all the blockchains except from Ethereum are second layer blockchains. So it was actually easy to get the transaction because I knew already how Ethereum works. And the data starts with 2017 and runs until 2023. And I have about 4,000 blockchain companies, of which thousands or about thousands are actually DAOs. And I wanted to show you how the DAO construct works. So the DAO is composed of several governance platforms. It can be off-chain on Snapshot. It can be also on-chain, which will be some smart contracts. And by getting all this information, I receive data on proposals and on votes. Then each DAO has several treasury or smart contracts on different blockchains. You can imagine as something as having different bank accounts in different countries. And then the more currencies you allow, the more sources of funding you would allow. So you would grow also because you would have more funding. And if I combine all the assets that are stuck or locked in these treasury accounts, and I can convert it to an US dollar value, then this would be the total value locked, or the asset size. So I'm defining it. Then there's a smart contract which regulates the module, or which would be the DeFi application. And there is the token governance smart contract, which regulates the token. And with this token, people can vote on the snapshot governance or on the governance smart contract, and then change either the treasury or the module account. And with this, or by getting the transaction data from the token smart contract, I would receive the number of members, or if it's listed on any exchange, I would also see the market capitalization. So by getting all this data, I can construct several indicators. For example, for valuation, I use, first of all, the size of DAO by summing up all these assets. But then maybe this is just one-sided information to just gather the size. So I constructed some ratios. For example, the efficiency of a DAO to utilizing the assets relative to the number of members, for example, or the comparison of market capitalization versus asset value. This would be some measure for over or undervaluation. So if the market cap exceeds 3 times its asset, it would be eventually overvaluation. Or, for example, the effectiveness of a DAO in utilizing its asset to generate revenues. From the proposal and voting data, I observe about 64,000 proposals, both off-chain and on-chain. And the first thing I was interested is whether these proposals are actually related to business actions, or is this just fun, for example, or people are really working on these problems and really contributing to the management of these DAOs. And I use some textual analysis, and I find that, well, most of these proposals are actually related to financial management, so like retrieving or adding funds to these treasury accounts, and then DeFi application, changing the parameters of this module, and then implementing some new governance rules or technical development or upgrades of a smart contract, or maybe hiring someone who can actually do these changes. And then there's community management, something like bounties or incentives to engage people in voting more. And in general, I have about 30 million off-chain votes and 32K on-chain votes. And with this variable, I can create governance variables. So I use, for example, for ownership concentration, the Gini coefficient, which is also done in several other papers. But what I'm doing is I'm dividing them. So I have the ownership structure of the token, which measures the Gini coefficient. And I have also the Gini coefficient for the voting data. And this is important in my belief because, first of all, you can have a decentralized company, but if only a portion of people are voting, then it would be centralized anyway in the end. So that's why I would measure both ways. And maybe just a small recap. I think I cannot come here to the example, no? Oh, no, I cannot. But just a small recap, if the Gini is 0, then it would be decentralized. And if it grows to 1, then it would be completely centralized. Yeah, and then I have more indicators on voting participation, for example, on speed, and also voting disagreement between large voters and small voters. So if there would be more difference, then there would be more disagreement eventually. So let me come now to the main results. So first, I'm interested whether the DAO construct is actually working on helping. So are these DAOs actually high-performing ventures? And as I said, here now I'm using the full data set of these 4,000 blockchain companies, of which thousands are DAOs. I regress the performance indicators on on the dummy, including market sentiment, which would be just Bitcoin or the log of Bitcoin prices. And yeah, here in industry dummies, and I see that in all performance cases, doesn't matter the timing, doesn't matter the industry, I would see that the DAOs actually, yeah, performing very well and increasing, for example, the size or fees per assets or some market cap per assets. And yeah, this doesn't really matter the industry. For example, I have here companies like Binance included. Chain is like any other blockchain company such as Polygon or Arbitrarium or Solana, for example. DEXs, as we heard, Arvis, their compound, farm, gaming, insurance, lending, NFT. Maybe you know OpenSea is included here, or Realty with real-world assets. Stablecoins, staking services would be something like Chainlink, where it offers Oracle services and yield. Okay, and then the second regression that I have is which DAOs are actually high performing. And here I just limited only to the number of DAOs, of which 165 are implemented on the blockchain. So everyone else has this kind of off-chain platform where you propose and then you delay the execution, or you have to trust that this execution is actually working. But on these blockchain companies, everything is coded, everything is automated. So I thought it makes sense to also distinguish these kind of DAOs where everything is automated and coded on the blockchain. And I regress again performance on the ownership variables, on the voting variables that I have, proposal topics, and the controls. And controls would be a dummy, whether it has actually governance on the blockchain, whether it has private access. For example, if you need a member to recommend you in order to join the DAO, whether it allows multiple tokens. So I also actually saw DAOs which allow multiple of tokens. And then strategic voting would be a dummy which uses a different concept. So it actually does not really matter how much tokens I own. I still would have only one vote. So this is the idea, to make it a bit more decentralized. And then the number of modules and transparencies and index on whether these DAOs actually have white papers, whether they're listed on Twitter or X, or have a discourse channel, or like anywhere you can find information on DAOs, this would summarize it. And the more they have, the higher will be the index. And yeah, let me show you the example, or the results. We see that ownership actually doesn't really matter. And voting participation and proposal participation, I actually divided them here, whether you have people who are actively participating in votes and people who are managing and actively managing this proposal. So there's like a difference in participation, and both are positive related. I also see that hierarchy actually matters in voting power, or in votes. So the more hierarchical the votes are, the bigger will be also the sizes, or the size per member. And speed also does matter. So the faster I vote in these proposals, the higher will be also the assets or the asset size per member. Found it a bit interesting that speed is negatively related to fees over assets. I also checked whether this is only related to fees. There's still a negative coefficient. So at the moment, I cannot really explain why the faster I vote, the more negative fees I would get. But I will definitely look into it. And well, disagreement is expected. I have low disagreement in general. That's why it's not significant, but at least the sign is correct. So the more disagreement I would expect, the lower will be also the performance indicators. And yeah, maybe this is the final slide. What I wanted to show you is that blockchain governance takes all the power. Actually, I didn't have it before, but it really takes all the power. So it really matters if everything is automatically implemented. This increases the assets size and the performance indicators much more than actually the other indicators. Okay, then yeah, in the end, I'm studying how DAOs perform and which actually perform well. And I observed that DAOs are extremely diverse and yeah, in voting activation, also market valuation. And I find that high-performing DAOs are actually the one with this active community, and it actually does work even regardless of the governance of the ownership structure. Yeah, thank you.
Thank you very much. Discuss anche sulla voce con European Central Bank. Thank you, Ursula.
Okay, thank you very, very much for the invitation to this conference, first of all. I just going back, same, I have disclaimer. These are only my views, my errors, just in case, not the views of the ECB. So I would like to start with the introduction to DAO. So this is this can be defined as a novel type of organization that operates on a blockchain. And I've seen also in the paper quite elegant short version of it, that pool crypto asset funds for a specific mission. So the goal of those organizations is to be fully decentralized. They aim to run autonomously without the need for human intervention or control, and provide a more open and democratic way for people to organize and collaborate. So there is no requirement for entry. Anybody can join this type of setup. So also one can think of as a kind of interesting type of organization if you think about the financial inclusion. So there are no barriers of entry. So DAO's participants take decisions through voting and coalition building. So participants can be pseudonymous and can exit DAO freely without any consent of peers. Oh, and then there is also this wisdom of the crowd, empowerness, because everybody decides, connectedness, everybody feel part of the group, openness, there is this community, and there are very low barriers of entry, so you have an internet and you can be part of DAO actually. Information about DAO's decision, this is very interesting, operations, but also performance is public and available actually real time. So, and this is on-chain and off-chain, so it makes it quite a dear data set to look at. But also they have limitations. For example, of course, we are looking at something that is in the new territory of regulation and also corporate law. Some people also claim that there is low speed of decision-making involved, technical expertise is required, and also a high security risk might be involved. So main question of the paper. So first let's start that the DAO's concept is premature. However, it's skyrocketed in popularity in the past 2 years, reaching $40 billion US in asset under management, over 10 million participants, and thousands of DAOs actually. So the questions, so in this context, the questions targeted by the paper concern the efficacy and also persistence of DAO. So can a shared and digital community of anonymous or pseudonymous people establish a fully functioning company? What are the underlying economics behind DAOs, and does shareholder democracy add more value to DAOs? So the paper answered these questions by creating and analyzing the most extensive data set to date on this topic and employing state-of-the-art analytical techniques. The paper contributes to the academic discussion on firm and fund performance, partnership, shareholders' activism, ownership structure, and it's drawing on and contributing to the research on blockchain economics and crypto assets. A couple of words before I move to a couple of suggestions. A couple of words about the ownership and governance in DAO. So usually a group of shareholders team up for a specific digital project and decide about the ownership, funding, governance, tooling, and also interaction. So ownership is established by distributing voting rights, and then keep in mind this quotation, we'll come back on it for the suggestion part among participants through the issuance of governance tokens. Then governance tokens can be also bought on the primary or on crypto exchanges if they are traded. Now, in terms of governance, DAO members can submit ideas, requests, or recommendations on which the community of owners will decide by voting. And voting logic is fixed and inscribed in the smart contracts. Usually it's one vote, it's one token, but also for or against within a time-limited proposal, but there are various models of voting exist. And some DAOs enable also scoping, voting, pre-voting using off-chain infrastructure. So, for example, using a communication platform. So, okay, then the paper, as also Valerie presented, look in the wealth of literature and compares DAOs to the traditional companies, looks at this free rider problem, agency cost, etc., and then derives the conclusion that Valerie presented. I have to say, in my version, there was no those beautiful tables with the final results, but I was pretty sure that we will see very interesting results. But before also going to conclusion, I wanted to really highlight this phenomenal data set that was created for the paper. So it's really a remarkable, a novel and comprehensive data set covering data indicators for DAO's landscape, proposals, votes, and performance. Data sources, Valerie mentioned, so I will not reply, but here again, we have a wealth of data sources and data that has to be processed. Very interesting techniques were used, and then the final sample, I mean, I think it's also Valerie managed in the meantime to extend it, and that also it spanned through the couple of years, capturing various developments on the market. Another, just wanted to here to include a list of variables that were presented, that were used in the paper, just to also show you the wealth of the wealth of data, the wealth of indicators. So now the final part. So I wanted to underline and praise the paper for contributing to better understanding of the landscape and features of DAO. DAOs by providing rich examples. Also, you can find it in the paper. Not only let's say generalizations, or but rich examples of describing the mechanism of particular DAOs. Then the paper devises a comprehensive set of indicators regarding ownership structure and members' voting activities. It provides valuable insight into DAO's proposals, and then finally contributes to better understanding of DAO's data and related challenges. Now, in terms of suggestion for consideration, so I was impressed by the data set developed, and on saying my version, I had this feeling that it would be great to deepening further the insights that can be obtained from the data set concerning the landscape, features, and operations of DAO. So I think there is really a wealth of information and insights available there. Then I was thinking that it would be interesting in this paper, but also beyond, to provide a bit further information about DAO's operation that go beyond ownership and governance. For example, I've seen that some DAOs involve voting on the proposals that are actually involved already pre-existing code. So meaning somebody already prepared the code that will be deployed. So, but it will be very interesting to understand how those proposals are prepared. So, do actually DAO's owner write the codes themselves, and also how DAOs collaborate with developers. And then maybe here I should also, in this context of this collaboration with developers, and this reference to the quotation mark when I was talking about the rights that tokens give to their holders. But in fact, there are no rights. The legal status of DAO, there is no legal status. So there is no rights, there are no obligations. Tokens holders, there is no even legal entity, being counterparty to any transaction. And in this context, I think that the paper is extremely timing, taking the developments in the regulatory field. So if you think about the market in crypto assets regulation, and then discussion which crypto assets will be regulated. So this one part is whether DAOs issue crypto assets will be the scope of MiCA, but also this kind of regulatory framework may actually make DAO rethink their legal status, the way they are operating, and so on, because so far there are no legal underpinnings, and even this contractual agreement with the developers, it's not clear. So yes, the one also comments for consideration is to elaborate on the sample selection. So I believe that there are huge challenges encountered when examining the whole universe of DAO. We have seen there are many DAOs, and then I think it will be also an interesting insight from the paper on why certain DAO are not selected for the analysis. So in a sense, it is also an argument in the context of whether those DAOs will persist or not, if we know more about those that are maybe created temporarily or not so relevant, not relevant, they closed, etc. And then finally, I think I consider paper relatively benign concerning those limitations. So I would see a bit more. I would see more, perhaps, descriptions of those limitations going forward. Thank you.
Do you want to reply, or you want to wait for other questions on the floor?
Thank you very much for the comments on
Okay. Any other questions from the floor?
I actually have this question on data. Like, when you say you have ownership process and members, do you really see like who is holding this voting coins behind? Like whether that be a private person, or because I can see that you might have wallet data, but I don't see that you can go beyond and then say, okay, this wallet corresponds to one group of investors, or it corresponds to one particular investor, or it corresponds to one institutional investor, because that matters for your decentralization conversation, right? So you might see that these coins, they will spread through a number of wallets, but it's not necessarily an indication of decentralization. So just one fact.
Thank you very much. It's a very important point, but I mean, it's blockchain design just cannot go through how the people behind the wallets. The only thing is I can do trade or when Uniswap or whatever, but I can still know that this wallet is the one who's holding not Uniswap. I need to know that Uniswap is but I cannot go beyond because it's impossible.
But yeah, I just want to, but yeah, hold it down maybe.
You're absolutely right, but it's impossible to do that.
Verifying. So when you calculate this vote, contest vote, you say vote for, vote against, and some actually make quite a lot of proposals, a lot of options, but before ABC, B rather than just two, yes and no. So that's one thing. The second thing is the strategic voting. I didn't quite understand exactly how you capture that. You mentioned to capture strategic voting to just collect all this information from Discord or Twitter or Reddit, I don't know where, social media, and see the activities and create index. Is that what it is?
Yeah.
Yeah.
Thank you very much for the questions. I think the second one I can answer easily. So where do I know that it's strategic voting? So first of all, there's the information already provided by the platform governance. So if you go to the governance or to the platforms, there's like a flag and I see whether strategic voting is applied or not. But then second, if I would calculate the Gini coefficient, it would be always 0. So I would also know whether it would be strategic voting or not. And then I can also see whether everyone is just voting with one token. So it doesn't really matter if I possess 50,000 of these governance tokens, I only have one vote. And then I see the weighting is always 1. So this makes it easy to spy strategic voting, for example. And then the first question was, sorry, can you repeat this again? On the options, exactly, yeah. So it's actually the case that you usually have 2 options. They would write, should we increase the parameter with 10%, or should we increase it from 2 to 3? Yes or no? Should we hire, or should we translate actually the money I saw to London Business School? Should we translate this amount to this school? Yes or no? There are sometimes exactly the cases where you have some options, but then there's always a winning option. So I could say if voter A is for the winning option, then it's 4 and everything else is against it. So this makes it also easy to calculate the acceptance rate, for example, or whether they were for or against it. Does this answer the questions? Yeah. Okay. Yeah, very well. Anything else? Okay, thank you.
So thank you, Valerie. So next presenter is Michele Falvi from the Center for Research in Economics and Statistics. So presentation is going to discuss blockchain design with transmission delays. Okay, thank you, Michele.
Okay, is this? Yeah. Is there a fountain?
There it is.
Yeah. Okay, great. So thanks to the organizer for having hosted me in Turin. So I changed slightly the title, but the presentation will be the same. So what will this paper be about? Okay, so before we saw several mostly finance and empirical related presentation. This one will be more about economics and incentives and technology. So I will develop a model of a blockchain, study the incentives of the agents that populate this model, do a welfare analysis of the whole economy, and conclude. Okay, now, first of all, why is it interesting to study a blockchain from the point of view of an economist in general? Well, because many mechanisms or markets nowadays take place online, and they rely on data sharing among their participants. If we think about, for example, machine learning or peer-to-peer file sharing, there are many examples. So all these markets requires participants to transmit data over the internet. But this data transmission is in general subject to latency. So the more I want to transmit or the more I want to communicate, the slower I will be in doing it. And that can affect the incentives of these market participants. Now, in particular, if I want to transmit a big bundle of data, there is an increasing probability that the transmission might fail. And if I'm rewarded for succeeding in doing this transmission, then I will hold some data. I will transmit less than the optimal amount. So I take this idea and I introduce it in blockchain models, because now in the literature we have many studies of blockchains, but I think this specific element, this micro foundation of the marginal cost of including data in the blocks, is not present in the literature up to my knowledge, and this is what I add in my model. So in blockchains, the blocks have to be transmitted among all the miners or validator or however we want to call them. And these delays that are proportional to the size of the block can lead them to produce blocks of suboptimal size. So what is the effect of the delays? They cause forks when there are two conflicting updates, and the forks leads to strategic capacity management by the miners. Okay, so what is my research question? Is to develop a parsimonious model to analyze the implication of transmission delays on blockchain design. So here I want to stress parsimonious model, because now in this research, it seems that we always try to catch up with every little innovation of the Ethereum community, but this goes so fast that 1 month you do something, the month after it already changed. So I think blockchain research, what really needs is to have something general and a bit more abstract. So this is what I try to do in this paper. Okay. So before going into details, I will explain a bit my view and the computer scientist view of what a blockchain is. Okay, so what is a blockchain? So a blockchain, I would call it a distributed and decentralized computer. Okay, it's distributed because it's managed not by a single server, but by a network of servers, and we call them validators, miners, whatever, nodes, I will call them miners here. And they store the history of operations, which can be payment, contracts, whatever, on their local machines. Okay, and it's distributed because there is free entry to this network in principle. So anyone can stake some coins or buy a computer and become a miner. This is the idea. So this is a traditional server client infrastructure, one server, multiple clients. And this is a blockchain, multiple servers, multiple clients that just submit messages to the network, and some server receives it and stores it. Now, a deep problem in blockchains and in distributed algorithms in general, according to the computer science literature, is distributed consensus. So one server can receive a set of transactions while another server can receive another one. But if they record payments, at some point the users want all of them to agree on a single history. So how is this problem solved? Well, in the most popular way is Nakamoto consensus. And here I'm not talking about proof of work, proof of stake. No, it's a general abstraction that encompasses all of these proof of whatever. Okay, so what is Nakamoto consensus? Nakamoto consensus is simply like this. At a given fixed time rate, for example, 1 every 10 seconds, the miner store the information that they have into blocks. And then, so the blocks, so the miner receives this opportunity according to a lottery. Then each time a block is formed, the miner communicates the block among the rest of the network, and then one canonical block is picked. So what is the rule to pick the canonical block? Is the longest chain rule. It means the concatenation of blocks that have the highest amount of data or computational power gives the history of transactions. Okay, now this is something that I want to stress because it's a critique that I receive often. Oh, but this is not proof of work, this is not proof of stake. But 1 second, it's the computer science literature, at least, does not care about this detail, because the computer science literature really cares about Nakamoto-style blockchains and BFT-style blockchains. So Nakamoto-style blockchains is everything that selects the miners, the block proposer, according to this inequality. So the identifier of a given block is obtained by hashing, by a cryptographic hash of the identifier of a previous block and something. And this has to be below a difficulty threshold. So we have several examples of Nakamoto blockchains. The most famous is Bitcoin proof of work, where the hashing, so you, is it working? Well, okay. So to form the identifier, you hash the header of the previous block, the transaction of the block, and you draw a random string. And this meets the difficulty. The second one, most famous is the Ethereum gas per proof of stake. So this is the mechanism of block proposals in Ethereum. So how does it work? You propose a block. So the history is divided in epochs. So every 100 block, there is an epoch. The first block of the epoch gives the random seed from everything that will happen afterwards. And then each miner has to hash the header of the epoch block, the time, and the public key for each of its coins, and then can find the block. Finally, there is another version that is essentially a replica of the Bitcoin consensus with proof of stake. Okay, so this paper encompasses all these versions. But this paper does not apply to BFT-style consensus. BFT is the alternative procedure, which is essentially a repeated voting. There are two-step votes. First, a block is, there are no forks in BFT. And first a block is produced. Everyone has to vote to, let's say, have to agree on the block a first time. Then, as soon as the block on top of it is proposed, a second round of votes arrived from the previous block, and then it's finalized. So Ethereum, so someone might say Ethereum doesn't hold, Ethereum is proof of stake, it's outside the scope of this paper. Well, I'm happy to get into this debate because I don't agree. I don't agree because Ethereum is an hybrid of Nakamoto consensus and BFT consensus. Block proposal is Nakamoto, block finalization is BFT. Okay. So, very good. What do I do in this paper now? Okay, in Nakamoto consensus, if everything would be, if we live in an idealized world with perfect communication, then all the miners would work on a single fork. I mean, on a single chain. There is just one blockchain. But given that there are transmission delays, it's possible that some miner creates a block and sends it to the rest of the network, while the others don't know about it. And when this is the case, the blockchain forks, as in this picture. And a fork is simply like a disagreement of the miners on the history of the blockchain. Now, how? Okay. So, for example, here just to explain the main trade-off of my paper, take this case. Suppose every block have a transmission delay delta once it's formed. This block here is proposed delta after this block here, so there is no problem. Thanks a lot. Okay. Is it on? Yes. So this block is delta after this, there is no problem. This block is delta after this, there is no problem. But here, the red block is proposed while the previous block is still propagating. So the network does not know that this block exists. So what can this miner do? What can this miner do once he finds the block? Well, it can attach to this one, right? Because where is it? Yes, because it still doesn't know that that this was generated. So a fork forms at the violet block. So this is the main trade-off that I introduce in my paper, and that will affect the blockchain design. Okay, specifically, what do I introduce in my paper? Well, this delta will be proportional to the size of the blocks. So the bigger data they put, the bigger will be the delta that the miners will face in their decision. So, of course, they cannot make the blocks too big because otherwise the probability that they get forks is close to 1. So there will be an optimal size. Okay, so they will trade off the risk of getting forks, of getting forked, with the revenues that they get from the block. And what revenues do they get? Well, they get a base fee. So typically they get a fee that is proportional to the amount of data in the block. And here one can say the usual critique is, okay, but there is the auction in blockchains. Yes, okay, there is the auction, but the point of this paper is really to give a, let's say, fundamental explanation for why we need a base fee. And in the Ethereum blockchain, it's not that it's just the auction. The fee mechanism in Ethereum has two components. Has a tip that you can pay to increase priority in your transaction and a base fee. And the base fee is proportional to the amount of data that you store. So this model is a micro foundation for the base fee. Okay, so what is my contribution? Indeed, I introduce the marginal cost of block space and the resulting trade-off. So up to my knowledge, this is not seen in the literature. So this is what I propose to add. Okay, so the equilibrium block size will be a function of the transaction fees on the marginal space used in the block. On the coin base, which I call seigniorage, I don't know if it's the best word for it, but in any case, it's the amount of tokens minted in each block, and the block production rate, because of course, if the blockchain produces blocks faster, it is higher the risk of getting forked. Okay, so the faster the blockchain, the smaller the blocks you get in equilibrium, and so blockchain cannot scale infinitely. Okay, and second, I would like to have this effect, the effect on the quality of the blockchain on the token demand. So for this, I not only model miners, but also users that will buy the tokens and a planner that has to optimize the system. Okay. So related literature, okay, there are many papers on blockchain. So this is the nice aspect of doing research of this, because you have to learn a lot of fields. From the market microstructure are the closest ones. There is Saleh, there is Uberman, there is Esley and co-authors. Financial and monetary economics, game theory, and computer science. So these papers, okay, so in the microstructure paper, there are already models that show some of the, so the trade-offs per se of this paper are not super new. But what is new is really this endogenous block size, I think, and the channel with the utilization. Yes, and all that talk that I gave before on what is consensus is taken from the computer science literature. So very quickly, my findings is that, okay, when you take into account that the block size is strategic, then the block size is determined by the ratio of the income from transaction fees and the income from the minted coins. So actually, yes, the block size increases in the base fee and decreases in the amount of minted coins, because the minted coins are awarded independently of the block size, and the fees are proportional. So that's the cookie to convince to give the incentive to make bigger blocks. Okay, then of course, when you have the delay, you have scalability that emerges for the reason we said before. So if I increase the rate at which the blockchain produces block, the miners decrease the size, so it doesn't scale. And finally, so in practice, blockchains give rewards also to forked blocks. So if you see Ethereum, they have this LMD ghost algorithm, and this giving rewards to forked blocks is a way to incentivize bigger blocks in equilibrium. And yes, there is also a reason for token burning that for the sake of time, I will not cover. So very quickly, the model, okay, the model has many elements, so it's full of ingredients, but it's overall quite simple, I think. So what's the model? Continuous time economy with infinitely lived agents. We have miners, so M miners that have value function VM. The environment is stationary, so it's essentially a static model, essentially. So then buyers and sellers of blockchain tokens, and a blockchain designer that has to maximize the aggregate utility in the economy. Yes, so the buyers and the sellers of the token, they meet and they want to trade using the blockchain, and the quality of the term of trade will depend on how good the blockchain, how well the blockchain works, and this will depend on the incentives of the miners. The miners will participate in the blockchain to maximize the expected discounted profit from doing so, and the planner will maximize the overall welfare. So what we want the miners to do? We want the miners to store transaction into the blocks, remain active with sufficiently mining power because otherwise the blockchain is considered unsafe, and then they have to entry. So safety requires steady activity and sufficient mining power from the honest miners. So this is the purpose of the paper. Let's say solving this maximization problem subject to 3 constraints on the miner. Recording, so in the baseline, the blocks will have 0 or 1 transaction just because I can solve everything, on paper. But then in the extension, I generalize to blocks of arbitrary size, continuous. They have to remain active over time and they have to participate. So going to the incentive analysis. So let's say the core modeling of the paper are the miners. Now it's a 25-minute presentation. I don't have time to go in all the details, but I will just give the main important elements. So the miners, so they have an entry cost and an energy flow cost for operating. They have to be active continuously. Re-entry, so what gives them the incentive to entry is to earn revenues from each block that they put on the chain. And what do they gain on each block on the chain? They gain seigniorage, that are the new token minted, and the transaction fees. So the value of this reward depends on here Z, that is the value of the token. So actually it depends on the demand. Now, so the interaction of the miners are a stochastic game. And essentially, each time they are active continuously, they see a list of pending transactions, and then they decide how many to put in the block. And each time there is a new block on the blockchain, a new stage game starts where the miners race to form the new block. So it's a Markovian game. I solve for the Markov perfect equilibrium, and I assume passive beliefs. So the miners take as given the blockchain growth and the distribution of the mempool. Okay, so just I will go with all the insights because there is not much time. Okay, key insight is this. So the probability, so when a miner decides to form a block, faces this probability. So it has to put the block in the chain, it has to be the fastest one. So the time it takes the miner to produce the block plus the transmission delay has to be lower than the time that all the other miners take in forming the block. So essentially, I find that when the blocks are binary, the incentive to put the transaction is that the ratio of the fee to the seigniorage has to be sufficiently high, and the threshold depends on the transmission delay, on the speed of block production, and on the competitiveness of mining, accounted by M here. Then why so for miners to create blocks, there have to be a positive transaction fee. Then for miners to remain active, there have to be a positive minting rate, because if there are no pending transactions, there is no income from fees. So in that case, the mining activity would drop if there is no base token reward. And finally, okay, so this pins down the equilibrium growth of the chain. Finally, what else? Yes, we pin down. So with these two, with the equilibrium growth of the chain, we pin down the equilibrium number of miners participating. And finally, with this, having closed the model, I will go to the design part. We can optimize the utility of all the agents in the economy. So this is how the, let's say, planner problem look like graphically. This line, so this is in the seigniorage transaction fee space. This line is the one that makes incentive compatible for miners to include data in the blocks. That is, fee to seigniorage sufficiently high. This line makes incentive compatible for miners to operate steadily over time. So seigniorage has to be sufficiently high by itself. And this line is the minimum miners participation that guarantees security for the users. So all these payment to miners are a cost for the user, so you want to keep them low. So the design space has to be on this blue segment. So the optimal point, we have to find it here. So the best thing to do, so according to my model, so in my model, let's say on the usage side of the model, I have a production cost for smart contract, essentially. So given that it's costly to operate the blockchain, you have to pay a transaction fee. Then that's the source of inefficiency in my model. So ideally, you would want only to use the seigniorage. You would want zero fee. This is an insight that is also related by one of the early paper by Chu and co-authors on still Bitcoin economics. But then if you take into account, so ideally you would be here. This is, let's say, the unconstrained optimum. But given that you have this incentive generated by the delay, you go here. So you use the fee as low as possible. That's the main insight. Now, okay, here there is the proof. Now, what's the optimal block production rate? Whoop. Sorry, this is going. What is happening? I think the pointer, yeah, there is something going on in the pointer. Oh, okay, yeah, sorry. Just let me get quickly here. Okay, yes, sorry about it. So that was for the optimization of the fees and the seigniorage. But now, what is the optimal block production? Well, you want the blockchain to go fast so that many payments are processed, but you don't want it to go too fast because otherwise you have forks. So let's say, I find that an upper bound on the block production is the reciprocal of the transmission delay. So this is the case because if that were not the case, more than 50% of the blocks would be wasted. Finally, okay, so this is the baseline. Finally, so, okay, I understand the baseline can be a bit restrictive because, okay, it's one block, it's a binary block, there are many limitations, but in the extensions, I try to address them. So first extension is continuous block size. And the nice thing that I find is that when we allow the block size to be a continuous real variable, okay, and okay, 1 minute I make it. And then you have a fee proportional to the space used. Then you find that the equilibrium size is, let's say, linear in the ratio between block time, yes, block time to delay, and then linearly increasing in the seigniorage and concave decreasing in the transaction fee. Okay, so this is the first extension. Second extension, what happens if we give rewards to the fork blocks? So also the forked blocks give coins to the miners that propose them. And then we see that it can essentially relax the incentive constraint. And in this, let's say, in the baseline version with the binary block, you can satisfy the incentives only with the minted coins without fees. Okay, so that's it. Just I will conclude very briefly. So what do I do in this paper is a parsimonious model of blockchain consensus and usage with transmission delays. That's the main contribution to the literature. What are the main takeaways from here? That's okay. The transaction fees can be inefficient when you have production costs for smart contracts, but they are needed for incentives. Then the equilibrium block size should depend on the ratio between the fee income and the seigniorage income, and then that scaling limits to blockchain originate endogenously. Now, what's next? So perhaps if we want to be more realistic, so the point of this paper is not really realism, it's not really to capture what happens in Ethereum, it's to try to be a bit more abstract and to simplify. But okay, if we want to make it realistic, okay, Ethereum has a Markovian fee structure because we know that Ethereum targets a block, an equilibrium block size. And so if in some period the usage of there are bigger blocks than this size, the period after it will charge a higher fee. And the reverse happens if the blocks are below the equilibrium block size. But these mechanics can be incorporated in my framework just by having a Markovian fee. So the fee at a block B depends on the size of block B minus 1. Then, of course, here the price of token is stationary, but you can have a generic process for the token, like a Brownian motion. You can make it more realistic there. And third, there's something interesting would be the role of MEV. So some say, like, is MEV good or bad? Well, one angle of analysis that could lead to think that MEV is good is that it can replace some form of distortionary rewards for miners. So instead of transaction fee, you have MEV, and maybe it can be less distortive. Food for thought. That's it. This is yours.
Let's see if microphone. Does it work? Yes. Okay, thank you for the organizers of the conference to invite me to discuss this paper. Thank you also, Michele, for writing this paper. This is a new world to me. And it took me, honestly, some effort. And I don't think I understand everything of it. I'm going to be upfront with you. So I have two comments that hopefully are useful, but see them from the perspective of a asset pricer and not a Bitcoin expert. So very quick, the background. I mean, this is not the first paper of this conference, so let me be quick. There's a decentralized ledger, so transactions in DeFi and cryptocurrencies such as Bitcoin recorded on a blockchain are not stored by a central bank. So the idea is very simple. As you know, once in a while, among the competitors of miners, one of them is randomly selected, randomly semi-random, and that is then a monopolist. And that person is then going to determine which of these transactions are going to be executed. But how do you decide that? Michele said, well, there's a trade-off. You can include a lot of transactions, but that takes some time. Or you basically include fewer transactions. You have a higher chance of being selected, but then you also get lower transaction fees. So who chooses those transaction fees? Traders that want to make transactions, they choose that. They make a bid. And then it is the question on whether they will be selected in the block. And every 10 minutes, there's a chance they will be selected at the discretion of the next local monopolist, the miner. So this is the strategic decision mission. Miners weigh fewer transactions to reduce delays and ensure block acceptance against more transaction fees. And yesterday was actually a seminar that explored more the market power of the miners. And I will have a short comment about it later. So this is the mempool that you can just go, if you search mempool Bitcoin, as you know, you can see them here. When I prepared the discussion 1 month ago, it looked like this. These were the transaction blocks that were executed. And this is the size, right? And you can see they are not completely full. If I'm correct, it's like around 2 megabytes, means it's full. This was the last completed block. This is the one that is predicted to complete. And also, it's not completely full. So there is some reason, which could be maybe the delay, transmission delay, that a miner would not put this to 100%, 2 megabytes. Here you can also see the transaction costs. And here there are 32 Satoshi, so 10 to the power minus 8 Bitcoin per byte, which corresponds to around $3. And 2 hours ago, when I checked again, and I put the same screenshot, the transaction fees are much higher. Now I'm wondering, why is that the case? And that is basically one of the discussion points I want to make. Of course, the trade-off you discuss in the paper will be part of it, but they are basically 8 times as high here. So what I want to see and what I'm wondering is all those external factors, not in the optimal contract, how are they essentially resulting into the equilibrium transaction fee? And the optimal contract is only one small part of it. And I want to understand how big that fraction is. And that motivates essentially my first point. Let me go there in a bit. First of all, as I thought, I didn't tell you yet, the paper is very well written, very complete. So the extensions I'm going to suggest probably do not even fit, but interest me given what I see here in, well, the data. Let's see. Okay. So without summarizing the paper, let me go to the first comment. I would like to see how this endogenous transaction fee that is now currently part of a contract generalizes in a market with a variable, essentially, demand for transactions. Right now, the market for transactions is not modeled, if I understand it well, but that's basically, to me at least, seems to be a very important part in determining the equilibrium transaction cost. And right now, of course, there is an equilibrium transaction cost, but how important is that contract really compared to the variability in demand? In other words, how important is the channel you discuss in the paper? That's my first question. Another one, which is not in the slide because I just discovered when actually checking this number, if we compare here the block sizes, here you can see that the block size completed is 1.52 megabyte, right? Then here, 1.47. I mean, a cutoff, they are all kind of more or less the same. The transaction fee is highly changed, but this is more or less constant. So even though if transmission delays are important, you would expect if there is low transaction fees, then basically, sorry, if there's high transaction fees, you would include much more because the trade-off you do basically favors you to include more and care less about the delays because you would get a lot of transaction fees. But that doesn't happen. So that's another method I want to say, how important is the channel you're studying? The second comment is more related to another question in asset pricing about high frequency trading. Maybe you've remembered those papers or discussions that essentially you would have to, these cables on the Atlantics that connect the New York Stock Exchange with the London Exchange. And the question was, is that welfare improving? Because then you would have a little increase in execution speed of a few microseconds, and a high frequency trader would jump in and get all the profits. Is that welfare improving? In your paper, I see a channel why this could be welfare improving, because the slightest possible increase in transaction speed would lead to lower probability of the forks, right? And lower probability of the forks will lead to a more simple design, and a more simple design means actually a welfare improving system. So still within the same context of transactions and finance, having basically a microsecond, maybe faster, could be welfare improving, all going through your model. So that is not a comment, but that's more like a thought, I don't know, that you could include. I know that was a very brief discussion, but hopefully these comments are useful. Again, this is very well written. I don't have anything to add on the main model. These are just a few side notes. I am wondering what I would do. Thank you.
Okay, so thanks a lot for the discussion. I know for I know it's a difficult topic because one has to really get be into that. This blockchain is not easy because there are many details. So let me address quickly. So the first, something I have wrote in the paper is that so for the Bitcoin case, so exactly. So in Bitcoin, the fees are determined by an auction. So exactly. So my paper, what wants to do exactly is this optimal contract. So it's more, how to say, what is the best thing to do? Like what is needed is like, okay, we need these fees because if in the real world there are delays, you have the fees. Now, in the actual blockchains, yes, in Bitcoin, the fees are determined by the auctions. And also the blocks are pretty small in general. So they are, yes, 2 mega at most. So the transmission delay problem is really limited in Bitcoin. It's almost inexistent because it takes you 10 minutes. You have 10 minutes to produce the block, but the delay is 10 seconds. But the problem of delays is relevant in Ethereum because in Ethereum, you have also smart contract data and the blocks can have like even 10 megabytes of size. So there it's a trade-off that becomes relevant. For Bitcoin, it's not so relevant. On the auction, so yes, one thought that I had on the paper is what happens if on top of this we add an auction, so like in Ethereum. base fee and tip. And my conjecture was that the auction can be even better because, first of all, well, if you have different heterogeneous priority for speed, then it can be good because like when the network is congested, transactions of like only people that value a lot the transactions get the chance to use the blockchain. And second, by pushing up, so the auction will create a pressure to push up the fee, and that will automatically solve the problem of the base fee that the base fee would solve with the delays. This is the first one. And second one on the welfare improving because you have a simpler architecture. Yes, I absolutely agree. It's an excellent point. Yeah. Yeah.
So I have two questions. So first, how much is this really a problem in practice? So in Bitcoin, I've been looking, I've not seen any fork in the last 2 years. On Ethereum, we have proof of stake. We know who the next validator is. Do we still have uncle blocks there? Is this still an issue? And second, there have been a lot of improvement protocols to avoid exactly this problem on Bitcoin and other blockchains. So all I need to do is submit the hashes of the transactions. I don't even need to submit the full 2 megabytes of block space. I just need to submit the hashes of the transactions that are in the block. Everybody sees the transactions in the main pool. Everybody knows what's in the block. So there's a lot of ways to reduce any transmission problem. So this becomes pretty irrelevant, I'm thinking. But.
Okay, so I will try to address the 2 points separately. So on the first point is like, to what extent is this relevant in practice and in Ethereum? Well, so I know now that there is the common view that is, okay, proof of stake is discrete, everything is already determined, and so this is not relevant. But I'm happy to have a discussion on this, and like soon there will be hopefully a computer scientist colleague of mine that will create a technical document on how the proof of stake works. So even in, so it doesn't work for the finalization gadget, that for sure, but for the proposal mechanism, I believe it is relevant because suppose, okay, at the beginning of an epoch, you are chose to propose a block. Then you have 10 seconds. So first point, you might be not the only one. So it's possible that there are 2 or more people that find the solution to the hash function. And second, then you have 12 seconds, even if you know when you will propose your block, you have 12 seconds to communicate it, to spread it. And so if you make it too big, then the validator after you will not see what you do, and then necessarily it will be forked. Well, I will be happy to continue to discuss on this.
Yeah, I think also in the interest of time, because we are 10 minutes late and the keynote will be online, so we can't postpone the keynote personally. We should do this discussion maybe in the coffee break. So sorry for the harsh interruption. Yeah, so then let's meet at 3:30, so just 20 minutes-ish coffee break, and then let's continue with the keynote. And thank you, Matthias, for discussing the paper. You shouldn't thank the organizer. I should thank you, basically, for not being part of the community, let's say. So yeah, then let's see.
You can see the screen, right?
Yes. Okay, great. Yes. Okay, then I think we can actually start. So yeah, it's a great pleasure to have you here virtually, giving this keynote speech for the second Torino Decentralized Finance Conference. And so the total block is about 40 minutes. Maybe we can have like 30 minutes of your presentation and then leave some space for questions. Yeah, thanks a lot, and I'm looking forward to your presentation.
Sounds good. Thank you so much for having me, share with you some of my and my co-authors' research related to the economics of using tokens. And here, to be truthful, the tokens don't have to be crypto related. They don't have to be built on a blockchain, even though, nowadays we are focusing on that. There are certain trade-offs between centralized and decentralized setup. And I'll mostly be focusing on staking. And given the time constraints, I hope to stay at high level and just to introduce the broad agenda and some of the exercises one could do, which I find very exciting. And over the years, we've grown a community of scholars who's working on this intersection of asset pricing, corporate finance, and monetary economics. So it's actually very rich in fundamental economic insights and issues. So I'll, with this audience, I don't have to talk too much about how or why we need crypto tokens or how tokens function. I'll delve into the kind of economic insights a bit more. But one piece of background information that I really hope to provide to you all is not all tokens are created equal. They are really serving different functions and should be compared to different existing asset classes or institutions that provide financial services. And we made an attempt to categorize tokens based on their economic functions quite a few years back, and I think they still hold, broadly speaking. And I would mention 4 major categories, and the focus is going to be on the first 2 categories. The first category, which I'm most interested in, is platform token. They are essentially, I think one useful exercise, at least for me, is to think about these digital networks as cyber nations or virtual countries. And in a sense, platform tokens would be for that platform as a cyber nation when we embed or introduce means of payment, store of value, so on and so forth. Basically, when we introduce the currency within that ecosystem, what's going to happen? Filecoin will be a decentralized version of Dropbox, Dfinity decentralized version of AWS, and Chainlink is a Oracle network. And we can really tie the functionality and valuation of tokens to the platform itself. And this is also an area that I think is most interesting due to the fundamental economic mechanisms that we can study, because this is where, when you run a platform, there's a lot of corporate finance decisions. When do we expand? When do we, how do we provide incentives, so on and so forth. But it's combined with asset pricing because we're introducing tokens and digital assets. And if we think about the supply of tokens, the burning mechanism, so on and so forth, we are really running a monetary policy within the ecosystem. So this is at the very intersection of all these topics. If we take the platform to the extreme, and if we allow it to be non-virtual, or at least include offline ecosystems, then we are talking about general payment tokens. And that's where the tokens are really, serving a function similar to what monies do, right, in the real economy or in the combination of virtual and real economy. I would put Bitcoin in that category. Ethereum probably belong to both categories. These categories are not mutually exclusive. Central bank digital currencies, there's a lot of great pieces of work that's written on that, mostly on the theory side. Many of you contributed to this field as well. Now the stable coins are growing. They're all serving this type of functions. And in a way, they interact more directly with the existing banking industry and monetary policy of countries. They are also relevant for currency competitions among various countries, or at least across various payment systems. So that's also an interesting category. But we probably need more kind of monetary economics and macro side of the issues to be put into the discussion. Now, the third category is, in a way, it's easier. There are certain tokens that are pretty much corporate coupons, non-fungible tokens included. They are ownership to certain products and services, or ownership to certain collectibles. It could be digital, it could be non-digital. But because we are talking about tokenization, so even for the non-digital collectibles, there is a way to tokenize them. So that's one category of tokens. They are not so much about using the tokens as a form of money. When we think about how we price them, it's pretty much how we price collectibles and how we price these service streams going forward. I've seen tokens that basically entitle you to certain real estate property ownership, so on and so forth. And the fourth category will be, maybe I shouldn't use security token because this is not exactly the definition by the SEC or other regulatory bodies, but maybe cash flow based tokens. These are just digitization of cash flows, and we know how to value them. Right? We have discounted cash flow models. And the truth is, across these categories, actually, there's strong segmentation. Empirically, the way these different digital currencies or cryptocurrencies behave is very different, even though they are kind of becoming more correlated, and that's something we document in an empirical study. Now, zooming into that platform and general payment token, what have we learned, right? There are many papers on tokenomics since the concept was introduced at least 6-7 years ago. We've looked into the roles of tokens. Why exactly do we need them, right? At least in the virtual network, they help to bootstrap the adoption. That's the word practitioners always use. And here, the endogenous adoption part is quite crucial because unlike a country, you don't, emigrate in and out all the time. But you can multi-home on digital platforms. You can, log in and log out, so on and so forth. So it's a lot more endogenous, and that turns out to interact with the token valuation and the functionality of token. So tokens can stabilize user base as well. There are studies introducing additional players into the ecosystem, right? Pure speculators. There are agency issues that we can look at. What I'm going to focus a bit more on, at least in this particular paper on staking, is the kind of it's related to the financing and incentivizing piece for decentralized contribution. And when we think about sources of value for these tokens, we know all monies are bubbles, so we need some sort of backing. I at least believe that the process will carry forward, and there could be multiple sources of value. And in this particular study, I'm just going to focus on actually the cash flow part, right? When you stake certain tokens, you derive a cash flow from that. So there's the financial investment value of tokens, in addition to the capital gain when you hold tokens within the ecosystem. And when we think about the sources of volatility, why cryptocurrencies are so volatile, at least based on observations so far, I already mentioned the endogenous adoption is quite crucial. The supply policy of tokens could reduce or increase the volatility of tokens, it turns out. There are equilibrium multiplicity that's playing a role that earlier studies have shown. And of course, there are fundamental technological uncertainties or regulatory uncertainties. So we'll be capture the sentiment and noise part a little bit in our exercise that I'm going to mention. So I'm going to move on to this topic of staking. I know in the title I put DeFi staking, but it doesn't have to be restricted to DeFi staking. But most of the examples will be in the DeFi space. So we basically want to develop a asset pricing model involving staking in two ways. One is in the fundamental layer of the network, there could be staking going on in order to generate consensus records of what's going on, right? Basically proof of stake. There could also be at a higher layer business models of staking where we can pool tokens for liquidity, for insurance, so on and so forth. And we're going to kind of use one model to think about both type of staking. Now, there are many nuances across different type of programs and also across the two layers. There's rich room for further exploration. We just want to provide an initial way of thinking about that. And there are several studies kind of pushing in the direction of better understanding staking, at least from a theoretical perspective. And I think a key difference is we're going to model both types of staking, and we're going to take the token supply policy as exogenous and think about the valuation of tokens. Whereas there are other studies that take the kind of the price process of tokens as exogenous and think about what would be a good monetary policy within the ecosystem. And methodology-wise, we're going to use mean field game, and I think that's one of the first applications in finance. In particular, we're going to deal with systematic shocks. So the problem is not very trivial. We'll have idiosyncratic shocks. It's a little bit easier to deal with. So moving on to staking, this is John worked with Zhiheng He and Katang, who are both at Tsinghua University. And in terms of the institutional background, we've definitely seen many programs running proof of stake. We've seen various forms of higher layer staking. Yield farming is related. Nowadays, we talk about liquid staking, which doesn't quite require you to lock up the assets, but I would say, at least for a long period of time, locking up the tokens and deriving a reward from that is a major form. And if we look at the major stakeable assets, sometimes they, on average, they offer a high reward rate, and some are as high as 60-70%, which seem too good to be true. And that's during an era where we haven't fully recognized the inherent risks in such systems. And there are various categories of staking. Some are for liquidity, Oracle, network security, derivative collateral, so on and so forth. But they roughly all follow the format of, you temporarily lock up the tokens, and you're going to derive a reward. And the reward is typically specified in terms of quantity. There's a fixed quantity of tokens to be given out. So if more people are staking, each one is getting less. So in a way, the reward rate is endogenous. It's not directly controlled. The quantity is directly controlled. That's not how banks work these days when we think about interest rate. But there were episodes where banks were also looking into the quantity rather than interest rate. And in terms of the informational environment, these programs are typically pre-announced. at least the way token rewards are going to be given and what the stakings are for are described in advance. So we're going to treat it as such. And in a way, we can really compare this to risky investment, buying of some sort of risky financial products, wealth management products, and the reward rate can be compared to the interest rate. And if we treat each platform or each type of token as a currency, as a virtual country, then naturally we can think about carry of crypto, because they earn a reward rate that's similar to a domestic interest rate. At the same time, the exchange rates between a crypto token and the fiat or another crypto token fluctuate over time. Okay. So let's start with the theoretical part. I probably wouldn't have time to go over the details of the heterogeneity analysis, which is very interesting. But hopefully I'll just convey the main intuition, and then we'll look at some empirical development. So the model is set up in continuous time, and there's one native platform, digital platform with an embedded native token. So there's one token. One thing that we definitely fall short of investigating is, what if you have multiple tokens? What if you have multiple platforms competing? And in general, within the literature of tokenomics, that direction is underexplored. There is a lot more that we can look into. I mean, Alberto and the co-authors were looking into platform competition quite early as well. So that's all related. But in this particular setting, for the platform that we're looking at, we assume the platform has a productivity process that's deterministic. So I use the green color to indicate the volatility part. Basically, we're not adding this. You could add this as a source of uncertainty, but it's not. It is not as tractable or useful. All we need is the platform productivity is evolving, and the drift is related, weekly increasing in theta t. Theta t is the aggregate staking ratio. We'll show that it's an important state variable of the system, and that's determined in the equilibrium. Basically, if you have more staking, let's say proof of stake, more people staking makes the network safer. We are going to look at a version where the drift is independent of the aggregate staking level. That's fine. Most of the intuition would go through. We haven't explored non-monotone effects of theta t, meaning the more we stake, the worse the productivity the platform has. We think that's not true in most cases, but you can argue for some specific examples, especially if the staking program is badly designed. That's going to happen. Now, agents are infinitesimal. They are price takers. There's a unit measure of them. They decide. So each of them start with a wealth. So their wealth at time t would be given by this WIT. They decide how much to allocate on the platform. XT is the amount in some numeraire that they allocate for transactions on the platform. Basically, they are holding them as a form of money in the virtual world. And LT is the amount that they decide to stake on the platform. NT is the amount that they hold offline, and they derive utility from the consumption. And also tokens provide them a convenience, very much modeled in reduced form. If I hold XT, this is the convenience flow I get. So the more I hold on the platform, the higher the utility I derive. NT is the endogenous measure of agents on the platform. In a way, we're trying to capture network effect. And AT is the productivity, as we introduced earlier. U is a function of individual type, UIT, and individual wealth, WIT. So U is kind of idiosyncratic preference for using the platform. If I'm a drug dealer, maybe I want to use, Monero or Bitcoin more. If I'm a coffee drinker, that's not the network that I want to use. Standard Cobb-Douglas production function, you don't have to worry about the flow cost term. It could be, maintaining the node or the attention cost. What's important though is the off-chain, offline transaction costs. And we need this to explain the violation of uncovered interest rate parity. And this is something that people working in international finance on Forex topics introduce as well. So if you consume YT amount and you're holding NT amount in the numeraire offline, the more cash you hold offline, the less costly it is for you to consume. The more you consume, the higher the transaction cost is going to be. So that's all very natural, nothing crazy. The price process for the tokens are going to be endogenously determined. Because we don't have any jump shocks, we're just going to write it as a general diffusion process, where the drift and diffusion terms can be time varying. What we do specify exogenously is the supply of token, the supply process. So QT is the amount of tokens in the system, and the reward that we're going to give out for the stakers is has two components. One component is related to the pre-announced total rewards. There's also distribution of rewards that's uncertain, which is given by this FT term. That could be coming from fees and all that. In the longer run, we have to use fees to maintain the staking program. You can always, mint new tokens, and in many cases, the total supply of tokens, eventual supply is hard capped. So, but at least for the ones that we look at during this phase of the programs, most of them are still relying on, minting new tokens, increasing the supply to reward stakers. So the aggregate staking ratio can be simply computed as, so LT is the number of tokens staked, QT is the number of tokens in circulation. Basically, we can aggregate the WALs that people are putting into staking over the total WALs that correspond to this aggregate circulation or issuance of tokens, token supply in the economy. So what we need to do is to solve a equilibrium fixed point problem. Individuals are going to take the reward rate RT, which is the number of tokens given out as reward divided by the total number of tokens as given. And then they decide how much they should stake versus, holding for transactions or consumption offline. Yet in aggregate, their action will determine the rate, right? Because the total level of staking will affect the reward rate. And the individual problem is standard control problem. They maximize their lifetime utility from the consumption. And the way we capture some sort of sentiment shock or noise shock is for the demand that we aggregate, there's a multiplier that's stochastic. And that's the only source of uncertainty. Again, you can introduce the source of uncertainty in productivity process. The main results and insights would remain the same, but it's a lot more tractable if we introduce it this way. And that's not to say that it's trivially tractable, because we are essentially introducing a systematic shock to the system. And when we think about heterogeneity, we have to keep track of the distribution of wealth and types of the agents. And when you have systematic shocks, what happens is the evolution of the distribution is no longer a deterministic process. So we have to deal with that. Anyhow, the token market has to clear. This is just the token market clearing condition. And so if we solve a baseline model without thinking about the heterogeneous types, right? Let's say the agents start with similar, with the same level of wealth and all that. You can, easily write down a PDE for the pricing of tokens. Now, there are still two state variables being involved: the productivity level of the platform and the aggregate token supply. So you can do a change of variable to convert it to an ODE and write down the boundary condition, which is quite intuitive. When the platform productivity goes to 0 value, that means the platform is worth nothing, right? That's the boundary condition we imply, we impose. And here are the main predictions from the model, right? Higher staking reward increases more staking. That's quite intuitive. Just like higher interest rate from banks, we look at from a partial equilibrium perspective, increases the amount of deposit and saving, right? Higher reward ratio leads to higher aggregate staking. Again, not too surprising. Number 3 and 4 are the main predictions. Higher staking ratio predicts higher price appreciation, and uncovered interest rate parity is violated. Basically, the tokens that enjoy higher price appreciation are also the ones that are giving out a higher reward rate. And why is that? That sounds too good to be true, but that's the case in the currency market as well, in Forex market. And the key driver for that is there's a difference in the convenience that we get, right? Both for online activities and offline consumptions. Remember, there's a consumption cost offline. So holding the numeraire versus holding the token actually has a relative convenience if you're thinking about offline consumption. So all those are related. And what's the intuition for the third prediction here, right? Higher staking ratio leads to higher expected kind of return of the tokens. The static intuition, which is not very accurate, is suppose the amount of activities that we have to clear is about the same in the ecosystem, and fixing the velocity of token flow. When you have more tokens staked and locked up, at least for that instant DT, you have less tokens out for circulation to clear these transactions. And each one has to appreciate in value in order to clear the same amount of transactions. A dynamic intuition, which we can see from this graph, is when you have higher staking ratio, that's when people prefer to stake tokens rather than using them on the platform. That means the platform productivity must be lower. So that's when the A is low. And when platform productivity is lower, that means the adoption of the platform, the wealth that people put into the platform, is relatively low. Now, if the drift of A is given by mu, that's related to staking ratio, or either that or exogenous given, right? So here the dotted line means without feedback effect. Basically, we allow the drift of A to be independent of staking ratio. Either way, when the platform productivity is low, the potential room for future adoption is high. That means the future demand is higher, and that means there's a greater room for appreciation of the token. I know this is a little bit heuristic explanation of the result, but that's the intuition. Now, if we look into heterogeneity, the problem becomes quite a bit harder, right? If the shocks to the demand or the sentiments are at the individual level, that's fine. You can use a Fokker-Planck equation to track the distribution of wealth going forward. But now we have systematic shocks. So I have to use what is called a master equation. It's essentially performing some sort of variational analysis with the typical HJB equation. But technicality aside, what we can investigate into is what type of individuals stake first. And it's not too surprising the wealthier ones would stake more and they increase their staking ratio earlier than the poorer ones. What's the intuition? Well, when you stake more, you get the reward rate, and we're all price takers. So it's a linear return. Whereas you hold more tokens for transaction, remember the convenience flow has a Cobb-Douglas form, so there's diminishing marginal return to your convenience. So at some point, you prefer to allocate more. As a rich individual, you prefer to allocate more to the staking side, because that gives you a constant return when you're a price taker in the economy. And so we can talk about redistribution across types and wealth groups. We can compute a long run wealth distribution, which is Pareto-like. And there's the general trade-off, which we observe in other economic studies on inequality. That is, when the platform is typically more productive platforms tend to feature greater and wealth inequality, both on-chain and off-chain. Right here, we can write down the form, the allocation expressions in analytical forms for both online and offline wealth. So basically, the high staking platforms are the ones with lower productivity, and that has implications for the overall distribution. Now, in the paper, we also look at transition dynamics, and you can introduce various shocks to the system to look at how quickly they recover, what are the implications for platform growth, as well as the wealth distribution. But in the interest of time, I'm going to skip that. I just want to briefly mention some empirical findings that would corroborate the model predictions, and they actually offer some additional facts that's worthy of further study, either empirical or theoretical. So we look at all the major stakeable tokens, taking data from stakingrewards.com. And we did a major update actually end of 2022. Our initial data was ending in 2020. So the paper has been, we've been working on this for a while, but they cover all the major stakeable tokens. So that's good. And here I'm just showing you how the staking reward ratio and aggregate staking ratio are positively correlated. That's one prediction in the model, and that's what we see in the data. No matter which time period we're looking at, staking ratio also increases with staking reward ratio. Again, that's the second prediction in the model. You can control for observable characteristics for various crypto currencies and add in the token fix effect, time fix effect. What is more important is actually these figures. Higher staking ratio predicts higher token returns. And that's what we see at the daily level, weekly level, and monthly level. One interesting aspect that comes out of the heterogeneity part, which I didn't have time to delve into details, is if you have large players, right, like super wealthy individuals, they also tend to play a role. In this particular case, it's not significant, but in a few other tables, they are important, just as the model predicts. And finally, we do document that there's UIP violations. We can basically take any pairs of cryptocurrencies, or a cryptocurrency with respect to US dollar or with respect to Bitcoin as the home currency, so-called home currency. And we do see that effect. And therefore, you can take long position in high reward rate tokens and short position in low reward rate tokens to derive a very high strategy return for your carry trade. And there's an additional nuance, right? For the ones that you take long position and short position, you have to think about, do I put the tokens into a staking program or I just hold them as a pure speculator? But in any case, these are the performance, at least until the end of last year, it's very high return. Now, if you worry that this is driven by the overall market, we can dispel that concern by looking at long-only assets as well. Here, the red line is just the top 50% of high carry assets that we can, for example, take long position. Even though there's a big crypto market crash or crypto winter, the cumulative return to the crypto carry strategy is still very high. Now, the carry strategy shows up in both the cross-section and time series. And we have some analysis on that. And the results are consistent with what we have in the Forex market as well. But I am not going to go into more details there. But hopefully I provide a kind of quick overview into the tokenomics field. As I mentioned, multiple tokens, multiple platforms would be interesting. Thinking about other functionalities, how tokens interact with, monetary policy and banking sector, so on and so forth, would be interesting as well. I'm going to stop here to take some questions. I think I did run a few minutes over the 30 minutes.
Yeah.
Sorry about that.
Perfect. Thank you, Will. Lynn, this was really, really informative. And yeah, perfect in time. So let's see if there are some questions from the audience. Yes, there is one.
Hi, Will.
Hi.
Michele. One question I had is that would there be a way to use the model to find the optimal, let's say, proportion between tokens that are stakes and tokens that are used?
Yeah, that's a great suggestion. So to do that, we have to specify the overall valuation for that given objective. We can think about what's the ideal proportion. But the problem is a little bit more complicated in the sense that that's taking the supply policy as given. So essentially, we're developing a staking program as a designer of the platform. We're designing a staking program, and at the same time, we have to decide on the monetary policy of the ecosystem. So they have to be jointly optimized. And that's where tractability becomes harder. So right now, the route we're taking is, fixing the supply policy. We can think about what's the optimal staking design. By adjusting the amount of rewards, we can find the optimal ratio that you're talking about.
Got it. Thanks.
Hi, Will. I have also a question. What guarantees existence and the uniqueness of the equilibrium with heterogeneity? Because this mean field game, it's hard to establish, no?
Right. We have some detailed discussion on the existence and uniqueness in the long appendix that we have. I think it still boils down to the functional forms that we're using in terms of what is the kind of marginal return from holding it as a transaction currency versus holding it, staking it for the reward. Like one is linear, the other one has a diminishing return, and they would intersect. But that's a quick answer. but we do provide more details on the technical assumptions, and there are many in the paper. And for that, we have to appeal to the mass finance literature. People who are working on
thank you.
the equations. Yeah.
Any other question? Okay, then thanks a lot again for the keynote, and yeah, obviously feel free to stay and join the rest of the conference. Hopefully see you soon in real life at some point, and thanks again for the keynote.
Thank you for having me, and also happy to chat offline as well. Thanks everyone.
Awesome. Have a good one.
Yeah.
Come. Is already online? Okay, so should we do it before? Okay, then let me just tell them. Yeah, so just 1 second. Adesso facciamo Alessandra. Sì, ottimo, grazie. Okay, then we're gonna anticipate the closing remarks basically before the last presentation. And yes, she's already online, and maybe Michele, you want to say some words?
Good afternoon, Alessandra. Do you hear us?
I do. I hope you hear me.
Perfect. Okay. So in this case, I leave you the floor. With us this afternoon, there is Alessandra Perazzelli. She is one of our deputy governor in the Bank of Italy. And Alessandra follow us on topics like innovation, fintechs, blockchain, decentralized finance, and so on. So I leave the floor to Alessandra for the conclusive remarks, please.
Well, thank you so much. I'm just jumping in from Rome, and sorry not to be there, with you in Torino. But I'm very happy, and thank you for inviting me to try to bring some closing remarks to what you have done. And I really in saying bidding my farewell to the event, I just want to express really my gratitude to the organizers and to the scientific committee, because you really have put together such a very interesting and rich program, and to all the presenters, discussants, and moderators for their participation. I just want to make just to start, I just want to make a general consideration. I think that if we look at DeFi applications, we can say that they do not provide anything new in terms of products and services, but they do mimic those services and products that are offered by traditional financial systems within the ecosystem of the crypto assets. And if we take an overview of the largest applications of decentralized finance, we find lending, we find borrowing, we find peer-to-peer transfers of value, we find trading activities, derivatives, asset management, and so this could imply that regulators, policymakers can just take take inspiration from a vast amount of experience and financial literacy research, and to take informed decisions and exploit opportunities and manage the risks that are associated to these emerging forms of financial intermediation. But probably the lessons learned from traditional finance can be of help here, but they're not enough to do the job that we need to do for at least three, main reasons. First, understanding DeFi is far more complex than traditional finance because of all the technicalities that are involved and new ways of providing financial products and services in a unregulated and a decentralized way. And second, I think that it's quite challenging to determine which of the current theories and analytical models may apply to an ecosystem that, has as a goal one of eliminating those entities to which the existing theories and models apply, precisely. And third, I think the ability of policymakers and regulators to evaluate the opportunities and the risks implied by DeFi is often, made difficult by relevant gaps in data. So, I think that the economists, are putting a lot of effort in trying and understand, this complex phenomena that are, dominated by automation, by algorithms, by smart contracts, and they use high quality data set and appropriate, techniques of econometry. And in this regard, I think that during your conference here, you have discussed a number of very interesting case studies that go from decentralized liquidity provision and yield farming to flash loans and automated market makers. So I think that we have learned that from some paper presentations that DeFi not only changes, the way financial services are provided, but also changes the way the economic agents interact with each other. And some entities, such as decentralized autonomous organizations, they are very different from traditional financial companies. And, they avoid hierarchy, they add more democracy to the decision-making process in management. And again, different users may have different incentives to join DeFi applications. So the interesting study based on data from DeFi lending market, for example, demonstrated that retail and institutional investors have motivations that they're not confined to the search for a yield, but also to a direct influence on protocol decisions and governance rights. So, all in all, I think that there are lots of interesting mechanisms that we can, learn from about in this evolving ecosystem, and economic research is allowing us an educational journey that can enrich our understanding on how technology is reshaping the landscape of the financial industry and that of central banking, from what we are concerned. I think though that we still have a long, road ahead. I think that the reason is that all the, efforts, intellectual exercises on DeFi are carried out in a regulatory vacuum. And that is in sharp contrast to studies about, players operating in the traditional centralized financial system. And the lack of a regulatory framework is a matter of concerns for at least two reasons. The first one being the fact that intermediaries and users engaged in DeFi protocols are exposed to risks that are already known from traditional finance. And these can be amplified by the specific features of DeFi, such as excessive leverage and risk-taking, liquidity mismatches, and interconnectedness. And second, a reason is that new operational risks and forms of market abuse may be inherent to DeFi in itself in relation to the underlying complex technology and the concentration of governance, which may lead to some collusion and unfair practices or flaws. So I think that we can state that the current dimension of DeFi is still small and the associated concerns are not yet overridden, but we are facing an upward trend in participation to DeFi applications, and the interconnectedness among decentralized and traditional financial institutions is also growing. So policymakers and regulators like ourselves to be, be proactive in their action so that, we can try and prevent negative externalities in financial markets and the economy, and developing, a regulatory framework that can, try and balance the so-called good innovation with financial stability, with consumer protections, and the smooth functioning of the payment system, which is, a central bank main goals. Now, we have the entry now into force of MiCAR, and this is the first important step towards trying and establish a system of rules and controls on previously unregulated crypto assets, but it does not directly address DeFi. And, I think that in such a fast evolving market, a first step would be to address regulatory gaps in the overall DeFi economy ecosystem. And a second step, which I think is more challenging, would be to promote the adoption of transparent and credible governance and establish self-regulatory organizations. And, finally, we could rethink our supervisory framework and maybe try to enable some new ways to apply prudential requirements. For example, the introduction of technology-based regulatory systems, and the so-called embedded regulations, where the regulatory requirements are, embedded directly into DeFi, that those need to be explored as a new solution to limit the risk-taking and build capital and liquidity buffers. In Bank of Italy, we're actively participating to the ongoing discussions in all the international standard setting bodies, such as the Financial Stability Board, the Basel Committee on Banking Supervision, the Committee on Payments and Market Infrastructures, and the International Organization of Securities Commission. And and taking all of this in consideration, I really appreciate that this discussion has taken place today. I think this conference has given us, an excellent opportunity to really reflect on how the academic research can help us in the decision-making process and in shaping some effective policies. And I'm sure that, Banca d'Italia and the Collegio and the University of Turin will continue to work together on all this. And I thank you for having me this afternoon. Thank you.
Thank you, Alessandra, for your nice words. Yeah, we're also looking forward for a continuation in this collaboration. And I pass the mic.
No, thank you again, Alessandra, for being with us. We know that your agenda is very full and comprehensive. I'll see you in Rome soon. And again, thank you very much for your participation. Thank you.
Thank you. Enjoy. Thank you.
Perfect. Then let's go to the last presentation about the new European regulation, which is coming up. So, yeah, maybe we can switch on the lights again, if that's possible. Thank you.
Okay. I promise that I will be very short, considering that we have 5 minutes to 5. I think it's a good idea to go out. Usually the weather, I think, has improved significantly for a good aperitif. Okay. In this presentation, I will try to share with you some remarks. Before starting, sorry, I need, as usual, to highlight the usual disclaimer that these are my personal remarks. This presentation does not involve, it does not represent, obviously, the official position of the Bank of Italy. Having said that, the idea is to try to share with you some remarks starting from a different perspective. The perspective is the perspective of a central bank, okay? So from this point of view, I decided to give a title of this presentation as DeFi, the Stone Guest. Okay, so in other words, in this room, in this moment, we have another, let's say, component of this discussion, which is the lack of regulation. Because at the end of the day, although today I have heard a very interesting, let's say, comments, inputs about how the DeFi works, okay, we need also to take into consideration that so far we have talked about a world that is without a proper, let's say, legislation. So from this point of view, however, I want to highlight that my perspective is a European perspective because by the end of June, okay, the bulk of the MiCA regulation, so the European regulation concerning crypto asset and partially also DeFi, will be entering into force. So from this point of view, I guess that it would be interesting to discuss with you two potential policy issues. The first one that I have identified is the idea or the concept of what is a full decentralization versus partial decentralization. And the second one is how we can regulate the DeFi, assuming that from my perspective it's important to arrive sooner or later to a legislative framework that in a way or another way is able to help us to identify what is under the umbrella of the European legislation, because this will increase the transparencies and also the clarity, okay, and what is outside the regulatory perimeter. For the time being, okay, MiCA says in a crystal clear manner, and this is, I am referring to my first bullet, that under the MiCA regulation, okay, only partially decentralized crypto services are subject to the European regulation. When we are talking about the full decentralization, we are outside the regulatory perimeter. So at least, okay, so far at European level, okay, as a jurisdiction, we have said that, okay, when we are talking about fully decentralization, we are outside the regulatory perimeter. And this has a significant implication from several points of view. Now, the point, and this is the first, I would say, policy aspect that I will share with you, is to, it's quite difficult to identify what is a partial and what is a full decentralization. So if I go through the more than 200 pages of the MiCA regulation, I just find a small recitals, the number 22, where the legislator, the European legislator say, there is a full decentralization. In this case, you are not subject to the rules of MiCA when no legal person, when no bank, no investment firm, so no intermediaries is involved in the process. So at least it's crystal clear that, okay, no intermediary, no party in this case, okay? But the point is that the empirical evidence has shown so far that, as I said, decentralization is not a binary fact. So it's not possible to clear cut and say this is white, this is black. So no matter, no discussion, okay, we are definitely under the perimeter of MiCA or we are outside the perimeter of MiCA. So the main question is, from our perspective, is how do we identify the full decentralization in order to be sure that we don't need to apply the MiCA rules. So from this point of view, okay, as I said, okay, how can I identify the partial decentralization? What is the parameter that I can use? And in this case, okay, should I consider the level of decentralization, the level of the infrastructure? So in other words, Should I have to consider the number of server, the number of computers, the structure of the blockchain, or other example, the feature of the governance of the DeFi? In case I have just one person with all the voting rights, okay, can I continue to say that this is a decentralized structure, or in case we have 2 or 3 persons? So in other words, should I have to focus on the number of the person and consequently on the voting rights? So just to give you another possible approach. Or third approach, should there be a ratio or specific proportion between the validators nodes, the ownership, the transaction, or other factors? So what I want just to highlight is not so simple to identify a common criteria or unique criteria to say what is decentralized, what is fully decentralized, or what is partial decentralized. And this is a topic quite important. Second policy issue. Assuming, and from my perspective, it's important to regulate the decentralized finance, the natural question is then how decentralized finance should be regulated. Which means what can we do in the short term, okay, for a financial stability perspective, for a consumer protection perspective, or so on. So I am just applying in this moment the typical central banks and supervisory categories to the crypto asset worlds, okay? So I am just moving, as this morning I have seen in many presentations, the traditional, typical regulatory toolbox, okay, to the new ecosystems that is in front of us. So the other question, and this is a crucial question in my opinion, is how can the technology development and impact the sector? Because one of the key points that I believe is, let's say, reshaping the finance when we move from the traditional to the digital finance, in particular to the DeFi, is the role played by the technology. Because if I consider just an example, the application of an algorithm and the artificial intelligence to smart contract, okay, I can boost significantly the efficiency of the process. And this could have significant impact, okay, as we have seen before, on the, let's say, efficiency of the smart contracts, okay, on the computation capacity, and so on. And other point, what is the interaction between the DeFi and the centralized finance? Are we sure that, say, let's say, a problem, an operational problem on a blockchain cannot have a negative spillover effect on the centralized finance? Because what we have seen is that, let's say, interconnection between the traditional and the digital world. So in this case, okay, it's more or less like to see that maybe there is a little fire quite far from my house, okay, but sooner or later, due to the interconnection, okay, this could arrive to my apartment. So other point, how can we deal with the decentralized autonomous organization, okay? So also from this point of view, okay, what could be the impact? So from this point of view, I have, I would say, a long list of possible items of desire where it would be useful to interact and discuss with you, because many of the, let's say, papers that today have been presented, okay, already raised this list of topics. First of all, the anonymity, that is a typical and a crucial point of the digital world, and in particular DeFi. And this feature has an unbelievable, incredible impact on governance, the business model, the prudential and transparent rule, because as I said during the lunch time, okay, as a central banker, when I have to write a letter and talk with the, let's say, the blockchain, where is this legal building where I can go and I leave my letter or send an email. Okay, who is my counterparty? Okay, so it's impossible in this way, at least based on the current framework, to understand, okay, who is my counterparty, okay, who is liable in case there is, let's say, a litigation. How can I apply an administrative sanction in case there is a violation, for instance, of the GDPR, the privacy rules? Okay, so it's quite difficult to discuss with, again, a stone guest, somebody that is there, but you are not able to identify physically. This has several implications from this point of view. So on top of this, okay, when we talk about DeFi, just to highlight, I have several elements that I should take into consideration. First, the AML regulations, okay, or the risk of a cyber attack. Okay, there are several pieces of legislation of the current regulatory framework that, okay, are there, and we have to try to identify how, if it's possible, to apply all these pieces of regulation to this world, assuming, as I said at the beginning, that we like to enter in this new field. So now, possible solution for this, for both problems. The first one, probably the natural one, is that in the MiCA regulation at European level, we have insert the so-called review clause, is Article 142, which says that, okay, the Commission will, by the end of 18 months after the entry into force of MiCA, prepare a new legislative proposal in order to understand if it's a good or bad idea to regulate, okay, the decentralized finance. Because so far we know, as I said at the beginning, that the full decentralization is out of our radar, okay? So the point is, it's important to start to think if and how to regulate this stuff. Looking ahead, okay, and today this conference is a tangible, let's say, an empirical demonstration of this. Regulators and industry should work together in order to understand what we have ahead of us. We need to understand better what are the risks and also the opportunity of this completely different ecosystem and business model, okay? Because before starting a legislative process, makes sense first to understand what we have ahead of us, what are the risks, what are the opportunities, and then decide around the table, okay, what is the best solution to write or for writing a new legislation. Here in the second bullet, I have just tried to identify possible, let's say, elements that could help us, not only as from regulatory point of view, but also from academia point of view, or take into consideration there are several stakeholders, okay, that can be interested in increasing the level of transparency and information of the DeFi world. So my assumption is that regulation clarity is needed because in this moment, as I try to demonstrate, it's not clear what is fully and what is partially decentralization. So maybe it would be welcome a clarification on this point. Second, definitely for the time being today, we haven't addressed the issue if retail or institutional investors are involved in this market, but from several point of view, it's not a little detail that we need to take into consideration. So also for this reason, consumer education and awareness, it's a crucial point that we need also to take into consideration if we decide to develop a regulation on this stuff. Then we need to regulate the decentralized system. As I said before, technology in this field is definitely a game changer because we cannot, also we have seen in the previous intervention of Michele, the role of technology and the implication that this implies. Last but not least, Please don't forget that I have seen today during all the presentation, at the end of the day, we are just discussing about trade. Somebody is buying, somebody is selling, okay, crypto assets, okay. Please don't forget that if there is a transaction like this, okay, we need sooner or later to settle this transaction, okay, and also the payment system, okay, is involved. For the time being, okay, we are talking about a settlement, okay, via blockchain, okay, and this has several implications for a central bank's point of view, okay, because we are building up a different approach to the payment infrastructure that so far we have in our world. So, in order to try to, let's say, interact with this new ecosystem, what could be the solution? Probably it's difficult to apply ceteris paribus, okay, the traditional regulatory, let's say, approach, okay? Because as I said at the beginning, in many cases in decentralized finance, I don't have a counterparty, okay? So for this reason, probably way forward could be it's better to use the soft law like guidelines, like benchmarks, okay, or try to verify if it's possible to monitoring the smart contract, the way they are built up and they works. Maybe we can try to increase the level of disclosure in order to create a sound discrimination about the different platforms, okay? Or we can ask for an audit of the functioning of the platform. Then, last 2 points, okay, liquidity, capital, and governance rules, okay. Not sure that so far we can apply, for instance, the liquidity coverage ratio that I apply to a bank, okay, to this new world. Prima facie, I don't think it's not so simple. Then probably, in this case, suggestions are more than welcome, okay, if you have idea about new tools and new instruments, okay, happy to discuss from this point of view. Now, an example of how the Bank of Italy is trying to manage, okay, this kind of issue is that a memorandum of understanding that we wrote 2 years ago with other 2 Italian universities in order to study, okay, how the smart contract works. The idea is to try to identify a taxonomy, and then based on this taxonomy, try to extract a possible good practice, okay, and in this way, try to share with the community, okay, with the market, okay, good principles that can help developers, okay, to build up a setup, say DAO or blockchain or a DeFi ecosystem that is, I would say, less risky. Okay, so this could be a solution, not the only one, but is let's say a possible way forward. So my last, let's say, slide is devoted to Isaiah Berlin, just to highlight that, as I said many years ago, okay, freedom for the wolves has often meant death to the sheep, in order to be clear that, okay, for the time being, we don't have a regulation for DeFi, okay, maybe as many times we have said this morning, we are talking about the market that is 1% of the total financial instrument at worldwide level. So a small fraction, okay, from a stability point of view, prima facie, somebody would say, okay, it's peanuts. But the point is that from a financial stability point of view, probably it's not so important, okay, the dimension. But there are other factors that as central bankers, we need to take into consideration, for instance, the link between the 2 different, I would say, ecosystem, I mean, the digital one and the traditional one. So probably there are other factors that we need to consider. And take into consideration that this guy was one of the most important, I would say, philosopher in the 20th century, and he was, let's say, a real supporter of freedom. So I think that is a good idea to take into consideration what he said. Thank you.
So are there any questions? Yes.
As, so adapting to this new environment takes effort, right? And I wonder, what are the incentives for a central bank to develop the regulations so that these can thrive? And how do you see these going forward in the next 10, 20 years?
The crystal ball, but definitely the incentive is to, as a central bank, we are interested in having a good innovation. So I don't think that there is a trade-off between, as normally, innovation and regulation. So regulation is against innovation. No, the point is that from our perspective, the most important thing is to be sure that we help the good innovation. So the point is the incentive to us to stay here and to discuss with you today this kind of paper is exactly this. So we want to learn. We don't believe that we have all the answer to the questions, but the only way to understand what is growing day by day, I mean the DeFi ecosystem, okay, the only way to understand is to sit down with the guys that are in the market, okay, with academia, and try to understand what are the interactions, what are the links, what are the risks, but also the opportunities. Because the point is that I believe that maybe DeFi now is a small, okay, part of the financial markets, but I don't know if in 2 years, okay, time, okay, we will have something like ChatGPT in the AI world, okay, a game changer that is able to reshape completely all this world. But it's important to be sure that we understand what is happening in front of us. And again, the critical point is that we believe that in this sector, the technology, the fintech, I come from a fintech department, okay, the technology we believe is the game changer. Because the point is, just to give you an idea, when you use a smart contract to settle a transaction, okay, and behind the smart contract, you don't know who is the guy that has developed this stuff, what is the intention, what is the philosophy, okay? I have several problems that I need to address. First, what is the forum law? So in other words, in case there is a litigation, okay, with my counterparty of Bitcoin, okay, in case I am just negotiating or trading a Bitcoin, okay, should I have to apply the Italian law? Or maybe assuming that my counterparty is in Ulaanbaatar in Mongolia, I don't know, honestly. Should I have to apply my, let's say, consumer protection, let's say, rules or what? Just to give you an idea, what are the governance rules? This morning I was talking with Lorenzo that in Germany, there was a case law regarding a DAO. At the end of the day, the judge, okay, consider liable all the participants to the DAO because it was, for him, was impossible to understand, okay, if there was a completely different, let's say, or legal separation between the physical person, okay, and the token that in that case was representing, okay, a fraction of your property in the DAO. Okay, so we have several legal issues, okay, and not only legal issues that we need to take into consideration. Because at the end of the day, again, it's very interesting. It has been very interesting today to see how the DAO works, how the liquidity pool works, okay. But please don't forget that behind this transaction there are institutions or physical persons that at the end of the day are putting their money. And sooner or later, in case there is a problem, somebody will knocking on our door and we need to give them an answer. Apologize, maybe it's quite, let's say, brutal the approach, but this is the work and the job of a central banker at the end of the day. Sorry.
Related to what you just said, and on a very general level, if something is really decentralized, then it's essentially a piece of computer code without a physical location, and it's not legally incorporated somewhere. So whom are we going to regulate? How do we determine which regulation applies, European Union, US, or whatever, and how we actually enforce that regulation? So whom are we going to sanction and how?
I don't have, let's say, an answer as I said, maybe at the beginning, so I underline again, I have a lot of concerns, doubts, and questions, okay? If you help me to find an answer, okay, welcome on board. This is what we are trying to do at international level, as my deputy governor said, in the Basel Committee, in the CPMI, with the colleagues of the ECB, and so on. What we are trying is to study, to monitor, and to understand what are, again, the risks and the opportunities, because it's crystal clear that I cannot apply ceteris paribus, so in the same way, what are the traditional instruments that I use to supervise and to monitor, say, a traditional bank or investment firms or asset management company. This is crystal clear. I don't have a clear answer, okay, honestly, from this point of view. Our possible answer has been, okay, let's try to identify possible benchmarks or a possible organizational solutions, okay? And we invite the guys that are able to develop new smart contracts, okay, to take into consideration these standards. It's a soft law, it's not mandatory. I don't have the power to enforce then, okay, this. But we have to start to develop a new regulatory framework. Because sooner or later, again, I don't know, in 10 or 20 years, this ecosystem will be roughly 50% of the total asset.
Yeah, thank you, Michele, for this amazing presentation. I really enjoyed it a lot. I have a question also maybe regarding to the similar topic. You mentioned some possible solutions, how we could regulate DeFi and these kind of blockchain applications. And you mentioned something like smart contract audit or like reports and then checking it. But actually these things are already in place, right? But we have already smart contract auditing.
Yes, we don't have in a regulatory framework.
We don't have a framework, but you said we want to provide regulation to the good ones, but the good ones are already doing this already on their own, right? No? There is, for example, MakerDAO and also Tether hiring consulting firms in order to make monthly reports. And these reports are actually very detailed. If you look into them, look quite similar to banks, actually, if you look at the numbers. And, you know, the very good ones are really trying the effort already. So I was wondering whether it's indeed necessary or whether you just let it go and wait, basically.
I try to give you an answer to this interesting question, and thank you for this, based on the experience that we have seen in Italy after the collapse of FTX, okay? Before FTX, okay, when we asked some, let's say, exchange, okay, can you give us information regarding the amount of reserve assets, okay? So we want to understand if, in case of a stable coin, okay, there is a clear and direct, let's say, link between the amount of the crypto and the asset backed behind the crypto, okay. At the beginning, they were extremely reluctant to share this kind of information. After FTX, what we have seen is that, okay, there is a race now to increase the level of transparency and the level of disclosure, which again is a positive signal, okay, that I take on board from the market. Now, the question is, okay, there are some, let's say, behavior that we consider positive, okay? Now, the question is, okay, should we leave, okay, the situation as it is, which means laissez-faire, okay, the market will identify what are the best solution, okay? Or we believe that from regulatory point of view, there is an interest in identify correct, let's say, approach, okay? I believe that it's better to be sure that this kind of ecosystem will be sooner or later included in the big family of the financial sector, okay? Because this increases the level of transparency, clarify what are the liability, okay? Obviously, what we should avoid in principle is to build up a level of, let's say, regulation that is too complex, okay, too burdensome, and we kill, okay, the baby and we do not give him the time to grow up. This is first point. Second point, as you said, it's true that what I have identified in the slide are, let's say, best practice. But the point is that from the time being, okay, they do not have any legal value from a regulatory point of view, because I don't have the power to enforce and to ask, okay, why you are doing this or that. Okay, so here the question is from a public perspective, okay, should we include this stuff, okay, in the European regulation? As you know better than me, obviously, you know that at European level, we are one of the few jurisdictions at international level have decided to define a clear regulation, okay? In the US, okay, we don't have the same approach, okay? In other countries like China, apparently they have decided to let's say, forbid completely this kind of operation, although they go to Africa then to do the same stuff, but this is another story. Okay, so my point is there are some aspects that for the time being we have not, let's say, dealt with. For instance, should we have a resolution framework for this stuff in case a decentralized world as an issue? Are we sure that the way that the governance, the way that the decentralized, assuming that we are in a full decentralized world, okay, are we sure that we don't need to have some resolution powers or resolution instruments? I don't know. It's just a question that I put on the table. I don't know. The problem is that I think it's better to think what could be the consequence in case we don't have these instruments and try to be prepared for, let's say, a worst case scenario. So at the end of the day, we work having in mind, say, a prudential approach. So this is something that you have to factorize in our interaction.
Great. Short one. Short answer, maybe.
Oh, sorry, the aperitif. So I said, so.
Okay.
From the point of view, so from the point of view of the regulator, do you see like blockchain, DeFi, DAO as a complement or as a substitute of CBDC and digital identity? Okay. So maybe that is for the aperitif.
Short answer. So I think it's better that we discuss this later, because we
Yeah.
really run the risk.
That answer I liked. Okay, then yeah, thanks again everybody for coming and presenting and discussing. It was a really great conference and a great day. Thanks for the organizers, the Collegio, the Bank of Italy, and the university, especially Elisa Luciano, who is basically sponsoring the dinner tonight from her research budget. She's not here, but I wanted to say it. And now we have basically planned an aperitivo. So we're gonna meet like in, let's say, 15 minutes at the entrance. We can walk all together there. It's close to your hotel. I will send you the address of the place as well, in case you want to step by your hotel quickly to, I don't know, do whatever. And then you can also join us. And otherwise I'll see you at, we meet at the latest at the dinner at like 7:45, 8-ish. So yeah, in case you want to join the aperitivo, we meet outside. I send you the thing, and then yeah, that's the plan. So then see you in a bit, and yeah, thanks again for coming.